I'm Ian, and I work for the Federal Reserve, the central bank of the United States. The Federal Reserve System consists of three main entities that perform key functions that serve the public and promote the health of our economy and the stability of our financial system. These key entities are the Federal Reserve Board of Governors, 12 Federal Reserve banks operating around our nation, and the Federal Open Market Committee. Based in Washington, D.C., the Board of Governors is the governing body of the Federal Reserve System. It's an agency of the federal government that reports to and is directly accountable to Congress. The board consists of 7 members, or governors, who are nominated by the President of the United States and confirmed by the Senate. Governors are appointed for 14-year terms. The Board of Governors oversees and sets policy direction for the system, including 12 Federal Reserve banks located around the country, which take the pulse of the nation's economic health from a regional perspective. The 12 reserve banks represent different geographic regions, or districts, and were set up based on regional economic considerations. Although supervised by the Federal Reserve Board, the reserve banks operate independently in many respects. The reserve banks carry out a number of core system functions, such as supervising and examining commercial banks and other financial institutions, enforcing compliance with federal consumer protection and fair lending laws, while promoting local community development and lending to depository institutions to ensure crucial liquidity in the financial system. They and the board also play a key role in another primary Fed function, fostering the safety and efficiency of our nation's payment systems, including distributing currency and coin to banks, operating electronic payment systems, and clearing our checks. In addition, the reserve banks act as the government's bank, providing services such as maintaining the Treasury Department's transaction account and issuing and redeeming U.S. government securities. They also act as a bank for banks by providing key financial services to banks, thrifts, and credit unions. The reserve banks also provide a wealth of information on conditions across the nation, information that is vital to formulating a national monetary policy that helps maintain a healthy U.S. economy and a stable financial system. The board and the reserve banks together help ensure that consumer and community voices are heard at the central bank through consumer-focused outreach, research, and analysis. This helps keep the Federal Reserve's actions, policies, and decision-making attuned to what's going on in American households, communities, and businesses, which are the foundation of our economy. The third key Fed entity is the Federal Open Market Committee, or FOMC, which brings together representatives from the board and the reserve banks to consider the state of the U.S. economy and set a course for our monetary policy in a manner that seeks to promote an economy that works for all Americans. The 12-member FOMC establishes an appropriate position or stance for monetary policy to help move the economy towards 2 essential mandates set for the Fed by Congress, promoting maximum employment and price stability. This occurs mainly through the FOMC's influence on interest rates and credit conditions, which can significantly impact financial conditions, including economic productivity and even spending and investment decisions by households, communities, and businesses. Working together, these 3 key Fed entities and the unique Federal Reserve System structure established by Congress more than a century ago help promote conditions resulting in a strong, healthy, and sustainable economy. For more information on how the Fed functions, visit federalreserve.gov and click on About the Fed. I'm Ian, and I work for the Federal Reserve, the central bank of the United States. The Federal Reserve System consists of three main entities that perform key functions that serve the public and promote the health of our economy and the stability of our financial system. These key entities are the Federal Reserve Board of Governors, 12 Federal Reserve banks operating around our nation, and the Federal Open Market Committee. Based in Washington, D.C., the Board of Governors is the governing body of the Federal Reserve System. It's an agency of the federal government that reports to and is directly accountable to Congress. The board consists of 7 members, or governors, who are nominated by the President of the United States and confirmed by the Senate. Governors are appointed for 14-year terms. The Board of Governors oversees and sets policy direction for the system, including 12 Federal Reserve banks located around the country, which take the pulse of the nation's economic health from a regional perspective. The 12 reserve banks represent different geographic regions, or districts, and were set up based on regional economic considerations. Although supervised by the Federal Reserve Board, the reserve banks operate independently in many respects. The reserve banks carry out a number of core system functions, such as supervising and examining commercial banks and other financial institutions, enforcing compliance with federal consumer protection and fair lending laws, while promoting local community development and lending to depository institutions to ensure crucial liquidity in the financial system. They and the board also play a key role in another primary Fed function, fostering the safety and efficiency of our nation's payment systems, including distributing currency and coin to banks, operating electronic payment systems, and clearing our checks. In addition, the reserve banks act as the government's bank, providing services such as maintaining the Treasury Department's transaction account and issuing and redeeming U.S. government securities. They also act as a bank for banks by providing key financial services to banks, thrifts, and credit unions. The reserve banks also provide a wealth of information on conditions across the nation, information that is vital to formulating a national monetary policy that helps maintain a healthy U.S. economy and a stable financial system. The board and the reserve banks together help ensure that consumer and community voices are heard at the central bank through consumer-focused outreach, research, and analysis. This helps keep the Federal Reserve's actions, policies, and decision-making attuned to what's going on in American households, communities, and businesses, which are the foundation of our economy. The third key Fed entity is the Federal Open Market Committee, or FOMC, which brings together representatives from the board and the reserve banks to consider the state of the U.S. economy and set a course for our monetary policy in a manner that seeks to promote an economy that works for all Americans. The 12-member FOMC establishes an appropriate position or stance for monetary policy to help move the economy towards 2 essential mandates set for the Fed by Congress, promoting maximum employment and price stability. This occurs mainly through the FOMC's influence on interest rates and credit conditions, which can significantly impact financial conditions, including economic productivity and even spending and investment decisions by households, communities, and businesses. Working together, these 3 key Fed entities and the unique Federal Reserve System structure established by Congress more than a century ago help promote conditions resulting in a strong, healthy, and sustainable economy. For more information on how the Fed functions, visit federalreserve.gov and click on About the Fed.
Okay, that really worked. So good morning and welcome. We're very excited to have everyone here. My name is Susan Foley, and I am a Deputy Director in our Payments Division, and I'm going to be leading you through today's events. So I'm very excited to have everyone and learn from all of you and your experiences. We're going to have 4 panels today covering key issues on payments innovation. They're going to cover things such as tokenization, AI in payments, stablecoins, and the use of digital assets in traditional finance. You can also expect to have plenty of time, just like this morning, to mingle and meet each other, folks you haven't met before in the industry, as well as Federal Reserve leaders. And speaking of Federal Reserve leaders, few at the Fed are more focused on these issues than Chris Waller. He has long-standing interest in new technologies and innovations in payments. As an academic, he wrote extensively about monetary theory and its intersection in payments issues. He has studied Bitcoin's early potential as an alternative currency and stablecoin's impact as a like payment instrument. In 2021, as a new Federal Reserve governor, he gave a speech on CBDC called A Solution in Search of a Problem. It proved foundational in terms of the topic and the discussion of that topic. Governor Waller is chairman of the Fed's Payments Committee and has given many speeches about payments, stablecoins, and DeFi. And now it is my pleasure to introduce Governor Chris Waller.
Good morning. All right. Well, thank you, Susan, and good morning to everyone. It's my pleasure to welcome you to the Federal Reserve Board for our first Payments Innovation Conference. My objective in creating this conference is twofold. First, I wanted to have a conference that focused on the new technologies that had come from the DeFi and crypto worlds and how they are entering into the mainstream payments ecosystem. My goal is to have a vibrant discussion about payments between traditional payment incumbents and the new entrants from the DeFi world. Second, I wanted to send a message that this is a new era for the Federal Reserve in payments. The DeFi industry is not viewed with suspicion or scorn. Rather, today, you are welcome to the conversation on the future of payments in the United States and on our home field, something that would have been unimaginable a few years ago. My view for the Fed from now on is embrace the disruption, don't avoid it. As you know, we are well into a technology-driven revolution in payments, and I'm here to say that the Federal Reserve intends to be an active part of that revolution. A number of technological advances are transforming the payment system. Stablecoins and tokenized assets making use of distributed ledger technology. The rapid adoption of artificial intelligence AI, and increasingly the convergence between these innovations and the traditional financial ecosystem. This includes the institutions and infrastructure that our economy has long depended on to operate a safe and efficient payment system. And yes, this also includes the Federal Reserve. The revolution in transforming payments is demanding change everywhere. And I will say more in a moment about some new ideas that the Federal Reserve is studying to support those innovations. I have spoken before of what I see as the 2 broad models of payments innovation in our market economy. The first is private sector-driven innovation. Most innovation comes from the private sector, which is motivated and best positioned to allocate resources and take risk with new technologies. The second model is when public sector entities, such as the Fed, build platforms and provide services that enable the private sector to more readily and rapidly expand new services to its customers. This should be done rarely and in limited circumstances where it addresses a specific market need. The posture of public institutions, including the Federal Reserve, should be to acknowledge and embrace private sector innovation that can improve the payment system while preserving its safety and stability, which are as essential to the new generation of innovators as they are to legacy institutions. Now let me pull back a moment and remind everyone how we got here. Since nearly its founding, the Federal Reserve System has worked to facilitate payment and settlement system efficiency alongside the private sector. From the beginning, the clearing services provided by the reserve banks obviated the need for daily movements of cash in armored cars with heavily armed guards. Long before we started speaking of the payment rails that are facilitating the kind of innovation we're discussing today, the Fed was running trains on steel rails to deliver and clear paper checks traveling across the country. FedWire began conducting interbank transfers through telegraph wires in the early 20th century. Fast forward today, where we have multiple infrastructures that settle interbank transfers in real time. Today's conference will focus on private sector-driven innovation. We have assembled 100 private sector innovators who are leveraging cutting-edge technology to create new possibilities in the payments landscape. Our panelists are engaging in integrating traditional financial payment rails with distributed ledgers, developing new products and services in the digital asset ecosystem, and leveraging AI in the payment system. It's worth noting that the firms engaged in these activities include banks, asset managers, retail payment firms, technology companies, as well as crypto-native fintechs. This is an acknowledgement that distributed ledgers and crypto assets are no longer on the fringes, but are increasingly woven into the fabric of the payment and financial system. Now, before we hear from these innovators, I would like to touch on roles that the Federal Reserve plays to support the private sector. These include serving as a convener to solve coordination problems and operating core payment and settlement infrastructure. We are also looking ahead, conducting hands-on research on tokenization, using smart contracts, and the intersection of AI and payments for use in our own payment systems. We do this to understand the innovation happening within the payment system, as well as to evaluate whether these technologies could provide opportunities to upgrade our own payment infrastructures and to enable us to have deeper conversations with the industry on these new technologies. While this is a good start, I believe we can and should do more to support those actively transforming the payment system. To that end, I have asked Federal Reserve staff to explore the idea of what I'm calling a payment account. Today, Federal Reserve banks provide access to master accounts and financial services to legally eligible entities following our guidelines for evaluating account and services requests. The payment account would be available to all institutions that are legally eligible for an account and would be beneficial for those focused primarily on payment innovations. This payment account concept would be targeted to provide basic Federal Reserve payment services to legally eligible institutions that right now conduct payment services primarily through a third-party bank that has a full-fledged master account. There are many eligible firms engaged in substantial payments activities that may not want or need all the bells and whistles of a full-fledged master account, or access to the full suite of Federal Reserve financial services to successfully innovate and provide services to their customers. The idea is to tailor the services of these new accounts to the needs of these firms and risks they present to the Federal Reserve banks and the payment system. Accordingly, and importantly, these lower risk payment accounts would have a streamlined timeline for review. Payment innovation moves fast and the Federal Reserve needs to keep up. To be more concrete, let me describe a possible prototype that I've been considering for this type of payment account, or as I sometimes call it, a skinny master account. The account would provide access to the Federal Reserve payment rails while controlling for various risks to the Federal Reserve and the payment system. To control the size of the accounts and associated impacts on the Fed's balance sheet, the reserve banks would not pay interest on balances in a payment account, and balance caps may be imposed. These accounts would not have daylight overdraft privileges. If the balance in the account hits zero, payments will be rejected. They would not be eligible for discount window borrowing or have access to all Federal Reserve payment services for which the reserve banks cannot control the risk of daylight overdrafts. Now, I want to be clear that this is just a prototype idea to provide some clarity on how things could change. The upshot is that, in my view, the payments landscape, as well as the types of providers, has evolved dramatically in recent years, and accordingly, a new payments account would better reflect this new reality. As Federal Reserve staff examine this idea, we will engage with all interested stakeholders to hear their perspectives on the benefits and drawbacks to this approach. So you will be hearing more about this shortly. So let me wrap up here so we can get to the really exciting part of the conference, not me blabbering, which is about innovation in the future of payments. So thank you to the panelists who took the time to participate, those in the audience who agreed to be here, and the many others watching online. And a special thanks to Fed staff who moved incredibly fast to pull this event together and fit it into a very busy fall schedule for the Fed. So on with the conference, and thank you for being here.
Thank you, Chris, for starting us off. So I'm going to introduce the first panelist to come on up while I give a few housekeeping items. All right, here they come. So as a reminder, Chris mentioned we are showing this online so that others that can't be here today can follow along with the exciting program that we have. We will also be using Slido. So when you came in, you should have received a folder. Within that folder, there is a QR code and link within it. We're going to ask that folks submit their questions for the panelists using Slido. And the question and answer window will be open throughout the whole panel to submit questions. You guys can come on up. Also, if you need Wi-Fi access right outside that door, there is a desk and someone can help set you up with that. And lastly, folks today who are wearing blue stripe on their name tags, you can ask them anything you might need and they will try to help with whatever you need. Okay, it looks like our panelists are getting set up. Okay. So our first panel will be bridging traditional finance with the digital asset ecosystem in their conversation. Our moderator is Rebecca Rettig, and she will be leading us through this first topic. Rebecca is the Chief Legal Officer at Jito Labs, a software company that builds critical blockchain infrastructure and DeFi applications for the Solana network. I will now turn it to Rebecca to start us off. Thank you.
Thanks so much. Good morning. Thanks to everyone for being here. It's my privilege to kick off today's conference with a panel about the convergence of our traditional financial system with a new system called decentralized finance, or DeFi. Before we jump into substance, I want to thank Governor Waller, Sunaina, Alex, Ria, and everyone at the Fed for convening us to discuss the evolution of our payment system. This type of forward-thinking, collaborative event allows us to ensure a cutting-edge and safe financial system and to ensure that the U.S. economy remains competitive. Starting the day with a DeFi panel is brave. It shows a willingness to engage with one of the thorniest questions on innovation: whether and how traditional financial institutions and traditional financial services will and can evolve with the advent of an intermediary-less technological system. Although there's not a universal definition of DeFi, in fact, regulators, policymakers, and industry cannot agree on one, I'll provide a brief definition for purposes of today's panel. DeFi is a software system that runs on permissionless blockchains and allows individuals and institutions to engage in economic transactions without an intermediary. There's been a lot of talk over the years about whether this new intermediary-less system can or will disrupt or replace TradFi. Very recently, ICE Chairman Jeff Sprecher spoke of his rationale for a recent investment in and partnership with a company building a widely used DeFi application called Polymarket. Mr. Sprecher said that ICE made the investment so, quote, "we don't get disintermediated." Two important things on this. First, unless you're really in the crypto industry, you're unlikely to even know that Polymarket is DeFi or even that it's built on a blockchain. Second, as of today, the total value locked in all DeFi applications comprises about 4% of the total crypto market and significantly less than 1% of GDP. In other words, there's an acknowledgement that DeFi has great potential to bring new disruptive features to traditional payments and financial services, but there is also a very long road to go. This road is paved with new technology. To that end, today we'll discuss the current state of DeFi technology, whether and how TradFi can use and integrate with it, and where we'll go in the future. This panel will also tackle the incredibly important questions relating to stablecoins' critical role in the DeFi ecosystem and examine tokenized deposits, as well as DeFi's potential future role in bank liquidity provisioning and liquidity services. The DeFi TradFi disruption question is unlikely to have a singular answer, and instead will, as the title of this panel notes, require bridges. Governor Waller said it well in his recent remarks at CBOS on the next frontier of payment innovation. He said, innovation is not an issue of TradFi versus DeFi, but rather poses an opportunity to harness the complementary strengths each has to offer, especially at a time where we are seeing increased convergence between the two. Today's panelists are at the forefront of this convergence, and I'm looking forward to facilitating the discussion among them and letting them introduce themselves now, and then we will jump into questions. Sergey, do you want to kick off?
Yeah, sure. Hi, everyone. Good to see many. Sorry. Hi, everyone. Good to see many of you again. Chainlink, on the topic of DeFi, powers approximately 70% of DeFi globally and over 85% of DeFi on top chains like Ethereum, providing data and other key services to make sure that the infrastructure underpinning the transactions and operations of DeFi are correctly executed. We also have a lot of experience working with stablecoins, powering their proper execution, basically. We're the largest provider of proof of reserves, which is the technology that stops over-minting events and incorrect minting of stablecoins, which I think will be particularly valuable this new stablecoin environment. We're also the most reliable provider of bridging technology for the capital markets, working with large organizations like SWIFT, the DTCC, JP Morgan, UBS, and others. So we cover the gamut of both powering the DeFi community and now well along into powering the capital markets transition into the, just like 5 different names. The digital asset, new revolutionary thing. So yeah, that's what we do.
Great. Jackie?
Hi, everyone. I'm Jackie Reeses. I'm the co-founder and CEO of Lead Bank. We have bank in our name because we own an FDIC-insured bank in Kansas City, Missouri. I started the company in 2022 after leaving Block, where I ran financial services, so all the regulated products there, and have also been involved with the Federal Reserve for 10 plus years. So I know a lot of the folks in this room, first through San Francisco. Lead is an infrastructure provider. We build infrastructure for fintech, crypto, consumer companies, and e-commerce companies, many of whom are the largest companies in the world, and all names that many of you know. We're an underlying infrastructure provider. We don't really have a consumer brand. And so as much as we power a lot of the products that you all interact with, you would only really see us show up through disclosures or through an announcement. And that might be Stripe. I know someone from Stripe is in the room. It might be Revolut. It might be Ramp. It might be Affirm. It might be Walmart. And so we work with a lot of different types of companies to provide their underlying infrastructure. I'm very happy to be here.
Thank you for having us. So my name is Michael Shalov. I'm the CEO and co-founder of Fireblocks. We provide infrastructure, digital asset infrastructure for financial institutions, basically a technology as a service. Our main customers are bank, fintechs, and other financial intermediaries that are involved in digital assets, stablecoins, and crypto. Been doing that for the last 7 years. We are servicing over 2,500 financial institutions today. And essentially the infrastructure has 2 components. One is basically what you will call wallet or custody infrastructure. So we help folks like Bank of New York Mellon, and others to create the custody technology for them to store digital assets. We also have the Fireblocks network that helps people to coordinate the settlements over 100 blockchains that we support. So through this infrastructure this year, there will be more than $5 trillion worth of digital asset value that is going to be transferred. With regards to DeFi, among kind of the category of the different institutional wallets, custodians, and basically that broad category, we were the first one that created an offering back in 2020 to interact with various DeFi protocols. And along the way, we basically kind of were helping with the challenge that traditional financial institutions and regulated entities have in terms of accessing DeFi. So I think we have a lot of experience in discussing about the topic we're going to chat about today. Thank you.
Good morning, everyone. I'm Jennifer Barker. I lead two businesses for BNY. I lead the Treasury Services business, and I lead the Depository Receipts business. And first, I'd like to thank Governor Waller for bringing us here today and the rest of the Federal Reserve. This is a really important topic, and the discussion is timely. We are at a really unique and extraordinary juncture. We have breakthroughs in distributed ledgers, tokenized assets, artificial intelligence, all of which are reshaping the payments industry, not only here, but across the globe. And these technologies, they promise payments that are faster, more secure, and more inclusive than ever before. But traditional services and traditional service providers still provide scale and regulatory standards and expertise that underpins every transaction. So today's shift isn't about blockchain technology immediately replacing traditional systems. It's about the two coexisting, and that's really where true transformation lies, on getting those networks to interconnect. So our task is to unite these strengths as they complement one another. Layering digital asset innovation onto proven financial systems will unlock greater efficiency, liquidity, transparency, security, and financial inclusion. Key tenets here are important to resolving delivery around real-time payments, data-rich payments, and modernizing for resiliency, security, and industry collaboration. So success will depend on the close collaboration amongst all of us, banks, fintechs, service providers, regulators, to build clear standards, resilient infrastructure, and responsible risk frameworks. So at BNY, we are committed to innovating by investing deeply in research, modernizing our infrastructure, and championing clear, adaptable frameworks that encourage responsible innovation.
Okay, great. So now we'll jump into it. As you could hear from everybody's introductions, obviously infrastructure and the technology itself is really the critically important part. So we're gonna really try to delve deep a little bit on the technology to start. And we're gonna start with the question of interoperability, which means the ability for various computer and software systems to share data and make use of it across different systems. Sergey, we'll kick off with you, because obviously interoperability is key to what Chainlink has built. They've built the Cross-Chain Interoperability Protocol, or CCIP, which is software that allows users to provide information across various different blockchain networks, so Ethereum, Solana, and many others. But how is CCIP currently being used, and you alluded to this a little bit in your introduction, by traditional financial services firms who are integrating digital assets into their offerings?
Yeah, sure. So can't seem to get that right. Not
I'm
good
a
at
full
this.
service
I
moderator.
wouldn't last long at the Fed. I can't even get this right. Yeah, so there's like two dimensions to interoperability in the TradFi world because of the existing investment in systems. So the first level of interoperability is getting the existing systems to work with chains, the existing data sources, the existing backend systems, the existing messaging standards such as SWIFT. All of these existing systems need to become synchronized. And this is where you hear terms like digital twin and fund tokenization and other areas. So there's one level of problems where you have to synchronize existing data, existing backends, existing messaging standards with the chains, right, for basic operations. And our position is that those existing systems are not going to be going away. There's a huge investment in them. They're highly regulated. They meet legal requirements. they meet a lot of very key requirements. So the challenge there is synchronizing them. This is the work we've done with SWIFT, the DTCC, and other groups that power those systems in big ways. The second level of interoperability is the cross-chain level, and that's because you have a lot of fragmentation, and that's happening because the cost of generating a chain is becoming lower and lower. So as the cost of generating a chain is cheaper, and as it's easier and easier for more institutions to make chains, there will be more chains. Also, there's various fee dynamics and other benefits to having your own chain. And there's also more and more public chains as long as VCs can make money from flipping a public blockchain coin. So as long as VCs can fund a public blockchain coin, and as long as that public blockchain coin can return a large amount of capital to them as a result of their initial investment, you can expect more public chains as well, because that's a very financially attractive business model for many people. So there's more chains. More chains creates siloed capital. Siloed capital creates risk and creates limitations to market growth. So you need standards, you need standardized ways to synchronize the existing systems and to synchronize the chains as they grow in amount and fragmentation. So that's what we have a lot of experience with. One of the main challenges that we found in working on that, different from doing it in the DeFi community, doing it in the capital markets community, is there's a lot of requirements around compliance. There's a lot of requirements around accounting, books and records, and all these different requirements that a transaction has. So the challenge in the capital markets with interoperability is not just connecting two systems, whether they're an existing system to a chain or whether it's a chain to another chain. It's getting the connection to result in a transaction that meets the books and records requirements, that meets the compliance requirements, and that meets whatever other requirements the regulator or the counterparties may have from the transaction, right? So that's the challenging thing, really, is making the transaction actually happen against all of those, accounting, compliance, identity, regulatory requirements. I'm really thrilled to see events like this. I'm really thrilled about the SEC's new direction and the CFTC's upcoming direction. Because that'll simplify that problem. But there will be a period of probably 2 to 5 years where you have to create a kind of hybrid system where the old requirements through the old systems still need to be met, but the new system needs to meet them. So that is kind of the challenging thing for transactions, I would say, in the next 2 to 5 year period, that are interoperable in the senses that I described.
Makes sense. Jackie, and my questions go down the line, but I didn't know the way we were going to sit. So, but do you think that the banking system can actually just to turn this question a little on its head, can the banking system manage the fragmentation of all of these chains that Sergey was alluding to? And how does the technology need to evolve from the digital asset side to be able to be used by banks and traditional financial services firms?
Yeah, well, I'd say in listening to that, it actually sounded like the banking system. And so I laughed in the back of my head as I was listening to this idea of extreme fragmentation, siloing, and the need to actually do compliance. That sounds eerily familiar as someone who owns a bank. But I think today, the banking system is not at all ready for it. Like, you have 2 banks represented here. Like, we're probably one of the biggest infrastructure banks in the US that deals with crypto and stablecoins, and Bank of New York is certainly one of the largest institutions that's like the gold standard for holding reserves and managing the crypto industry. And so you probably have 2 of like 10, I would say. Having said that, there's a bunch of things that banks have to deal with that I think are probably the most likely use cases to hit banks at first. One is wallets, and that's consumer-related wallets. The second is infrastructure. I think on the infrastructure side, you're seeing that evolve today, and that's infrastructure of dealing with BIN sponsorship, moving money, storing money, and kind of the overall management of on-ramps and off-ramps. And I think that infrastructure has actually been established by players and operates quite well within the system today. I know we work with over 150 plus crypto companies, hundreds of accounts, tens of billions of dollars of money that flows through on a fairly regular basis. That happens very fluidly following all the KYC rules that are required and all of the institutional knowledge that we've had for 90 years of developing a banking system in the United States around like core banking law. So that exists today. On the consumer wallet side, I'd say that's probably the least sophisticated, and I don't actually see like a use case today for like stable coins and consumer wallets. No one is sitting there going, I'm gonna use my $25 worth of stable coin at Starbucks. Like that kinda, it's a nice theory, but I don't actually see any transaction volume that's happening on the consumer side. Where you're gonna see it though is institutions that have moved their infrastructure, and over time it'll become more prevalent as banks adopt stablecoin wallets, most likely through their core providers like Fiserv, Jack Henry, and FIS, who will enable it so that you could have interoperability between crypto companies, fintech companies, and core financial services. And so those wallets will be onboarded probably within the next year or two by these companies who have been watching Genius Act. But those are the two more likely use cases for where it happens. And I think on the stablecoin infrastructure side, you won't really notice it as a consumer, it'll just happen in your payment devices. And those rails will start to get moved first by multinational payments and then second through more domestic payments, largely because the infrastructure has started to move over those rails if, and I say if, there's an advantage in terms of actual cost and speed versus theoretical cost and speed, because we also are having this intersection of FedNow, which is a 24/7, 365 payment rail that actually works today. And so users could send a significant amount of money. Adoption isn't that great, but that actually does exist. And so big institutional users are going to debate which rail is actually more economically advantaged in which to send money.
Yeah. Michael, I want to get to custody and wallet infrastructure in a second, but because of how Sergey teed things off, Jennifer, I'm actually going to ask you, so what liability, counterparty, and settlement finality issues emerge when you're bridging these open smart contract systems that DeFi is built on with these regulated banking systems? No, for you. Michael's coming. Oh, in a second.
Sorry, I thought you said both of us.
No.
Yeah, I mean, I think that's a very interesting question, right? Because you have the question of, an auditable chain and figuring out, and as you mentioned, Sergey, all of the data has to travel with that. So you have the question of finality and you have the question of revocability, right? And so on chain, things are final, but there also probably needs to be a revocable process just like you have today with wires and other payment systems. So I think it's a really interesting question of, is it final on chain, but what is the process to really have it be revocable if needed off chain and through the regulatory environment?
Oh, that's very interesting because I mean the whole point is for it not to be revocable in many ways, although certain obviously stablecoin issuers are, I think, thinking about revocability. Okay, so to move to a different part of the infrastructure, but that is just as equally important, as you said, Fireblocks builds wallet infrastructure. And Michael, talk about how the custody broker approach today in traditional financial services contrasts with wallet infrastructure and sort of other digital asset technology, just to set the stage, and then I, of course, have a number of questions.
Yeah, so I think that first of all, when people think about custody, I think what they have in mind is either how banks used to have safes and they would basically store bare assets in those safes, or maybe like, the entire books and records, right, that currently exists in terms of some kind of like, tree that at the top level you have something like DTCC and then kind of propagates to the various intermediaries that are creating a hierarchy of sub-accounts. The reality is that actually that function in blockchain and crypto is actually provided by the blockchains themselves, by the L1s. They're the ones that's kind of the books and records. And what you do as a custodian or as a wallet provider or basically the safekeeping element is actually storing the password, right? Storing the private key that is the instruction to move either an asset from one wallet to another or operate a smart contract on behalf of that account. So conceptually, it's a bit different. On top of it, unlike, I would say, like, in the traditional space that, okay, there is basically one safe, right? You can actually operate much more sophisticated and improved mechanisms to increase the security, right? So instead of having, for example, one private key, one of the things that Fireblocks and a few other folks have built over the last couple of years is this concept of multi-signature or threshold signatures or multi-party computation, but essentially it's a virtual system that distributes the ownership over a wallet, right? So you need multiple parties to actually sign a transaction simultaneously to instruct the movement. And that creates like a much larger or much greater resiliency, right? From both a cybersecurity standpoint, counterparty risk standpoint, operational risk standpoint, compared to modes that you have in the traditional space. So that's kind of one important element that it's quite interesting to bring. I mean, it's actually nowadays when you look at all the crypto and fintech players, they all have adopted it. Also, in terms of most of the retail wallets, they've adopted it, and also I think the banks that have partnered with us, they have also adopted it. But generally speaking, every time that we do talk with bank, especially like, bank IT, it is a fairly complex journey to get them think about how they can enhance their resiliency in that regard. By the way, that type of technology actually proven itself to over the last couple of years to prevent quite a lot of disastrous situations in terms of theft in the crypto space. And I think that part of what we are working on right now is the regulators globally, and I think the more exciting thing is that we now have the opportunity to work with the regulators in the United States, is to actually bring frameworks, right, similar to what you have in Europe, like DORA, to bring similar frameworks into the US that will help regulators and traditional financial institutions with scoping and understanding how to implement those models, and make sure that as we build or embed those capabilities within the traditional space, we are doing it in a secure and safe way, because it's true, I think, like, Jackie and kind of alluded to that, there is sort of a hump, right, and that's also been our experience working with some of our partners over here, is that there is actually a pretty significant effort that goes not actually in implementing the wallet infrastructure and the custody technology per se, but actually integrating it into the traditional systems. And it's not only integrating in the traditional systems, like just connecting those APIs, it's actually also to evolve the processes and the procedures and how IT is actually going to consume that within the bank. And the reality is, probably won't be surprised, right, that most of the banks, whether they develop their core banking systems internally or they're using providers like the providers that were mentioned over here, those providers and those systems that were built in the 70s, 80s, and the 90s, they're not really equipped to deal with it, not only on the level of the fact that they're doing batch processing once a day, but actually even change management that sometimes expected to take weeks or months, right? You now have a situation that there is a fork on the Ethereum blockchain, and you need to update all your nodes to the fork, right? And you need to do it in the next 60 minutes. And if you're not going to do it in the next 60 minutes, you're going to be disconnected from the main ledger, right? So those processes, those IT processes, they also need to be evolved within those financial institutions to actually deal with this technology.
I was going to ask you as a follow-up what current banking practices need to evolve to be able to, but you already answered it. So, so Jennifer, we'll go down the line from you, but what's the biggest technological obstacle in having traditional financial services or banking firms plug into DeFi itself today? So applications like Uniswap, which allows for permissionless swapping of assets, or Aave, which allows for lending type activity, and then if you can each say what you're doing from your particular vantage point to try to move past these technological obstacles, that would be great.
Sure. I think the reality is you have to have expertise in both traditional systems as well as digital asset systems to understand how to integrate them and how they can best work together. So I'll start with some of the work that we're doing on the traditional systems. We were one of the leaders with real-time payments. We were actually the first bank to send a payment. When the credit limit increased, we were the first bank to send a payment there. We were one of the first banks on FedNow. The power of immediate payments is so important in this economy, and we continue to work with our clients and the 9,000-ish banks, Jackie, you mentioned adoption, we still have more work to do, right? And so getting those consumers and those communities access to immediate payments is a really first important step. Second is being able to move dollars 24/7. That is a big use case, particularly from our bank and our corporate clients who want to be inside the walls of BNY, able to settle dollars 24/7. So that's a really, and by the way, not a lot of banks can do that, which is why the digital asset structure really can potentially leapfrog some of the bank legacy infrastructure, but we've done both to make sure that we're ready. And the third is, AI, and we are heavy users of AI, particularly in the payment space, whether it's payment efficiencies and the operations, whether anomaly detection, fraud control. AI is going to really help us get more efficient and provide safer and faster payments. But then also across the industry broadly, ISO 20022 is really important because as we've talked about today, it's about setting standards. And that's why ISO is so important, and we've leaned in so heavily. We've tested with clients, we've worked with Swift, we do a lot of speaking on it. So it's really important to continue to control and really go out into the market and think about standards. And then, there's lots of folks in the industry thinking about it. I know CHIPS and Fed are also exploring, expanded settlement windows. So all of these things work together to make the traditional infrastructure more efficient. Okay, so, but there's still gaps, right? There's 90 plus immediate payment systems around the world. There's hundreds and hundreds of clearing systems around the world. We see that illustrated sometimes in cross-border payments with the different formatting. So there are still some efficiency that the digital asset ecosystem can really help us solve. And, if you think about, you mentioned digital asset custody. We launched that several years ago. We are heavily researching and working on both. And so we launched digital asset custody, and we have already integrated the traditional and the digital asset rails together in one application. So expand that to then stablecoin and some of the on and off ramps that you have between fiat and digital asset. We do that today for many clients and many of you in the room. And we work very, very closely with many digital asset providers, just even providing traditional banking services. So I think that's a really important part of learning that as well. But the interesting thing about BNY is, we touch about 20% of the world's investable assets. We clear $2.5 trillion of payments every day. So we have an obligation and an opportunity to really work together across the industry to continue to really set these standards. And whether that's through, Agora or Swift or Guardian and all the other projects that are going on, we're doing both of these things in parallel because ultimately they have to be able to work together.
Michael, how are you bridging the biggest technological gap between bringing DeFi and TradFi together?
Yeah, so Rebecca, I think that we've started at 2021 when we did Aave Arc together, when you were at Aave. And I think that at the end of the day, the journey that we started back then, so Aave Arc was, I would say, the first project around DeFi back in 2021 that was really catered into the institutional client. And what we identified at that point in time is that for any intermediary that basically has some license obligations, whether money transmission, trust, banking, the compliance element and then the permissionless nature of DeFi were not really resolved, right? And we created basically a permission level on top of permissionless DeFi that solved that. Now, kind of fast forward to today, we have a bunch of projects in flight that are integrating DeFi and also providing the compliance layer for DeFi, targeting the institutional market. I would say that the main appetite right now over there is coming from the large fintechs, like the names that were mentioned here before, that they are, whether it's like the Stripes, the Revoluts of the world, etc., that they're already digital ready. I mean, they already have wallets, they already have like sizable amount of users in the tens of millions of users that own crypto assets and specifically stablecoins, and they want to figure out how do they now leveraging Aave, Morpho, Uniswap, all those things to basically give their clients better, more robust access to those markets. The way that we do it is basically twofold. The first one is really creating adapters and infrastructure for them that allows them to interact with those markets through a secure API. So something that we didn't talk about over here is actually the security element of accessing DeFi. Some of the questions over there is like, how do you know that you are accessing the right DeFi smart contract? How do you know that you're sending the right transaction? How do you have the right permission level and all the approvals that are needed to send a transaction? So we basically solve all that for them. We call it a native DeFi solution, so it gives them all the security that we were able to figure out for them for their CeFi interactions. And the second element is, which is actually still in the works, and I think that this is where a lot of collaboration is happening right now with the regulators, is really solidifying the approach around the compliance and kind of how do we KYC and how do we making sure that there is no illicit financial activity within those protocols, which is basically, if I'm now doing a swap on Uniswap, how do I know that the other guy, that the counterparty on the other side is not from North Korea, right, or some kind of OFAC sanctioned entity that if I own MTLs, e-money license, trust, that will be a huge issue. So, so for that, there are a few approaches. There are some of the traditional approaches that we've taken, like whitelisting, and now we actually have a team that is working on kind of the next iteration of that is using on-chain identity. And we think that on-chain identity, that is just like, a much broader component within the regulatory landscape that is now being looked at across pretty much like every regulator globally, bounded into that utility is going to actually unlock this for both retail, institutional, and probably will solve that in the most elegant and technologically native way.
Yeah. One quick anecdote before I turn it over to you, just about Aave Arc, which is from a compliance perspective, back 5 years ago now, we used one of the blockchain analytics companies to do an analysis of the smart contract pool of all the assets that were in the pool and to see what the connection was to any wallets that were associated with illicit finance. It was very, very low, and so we were able to sort of put that out there. And I just went back to the same blockchain analytics company maybe a month ago to ask about it, and the guy that I know there very well said, you were the only people to ask for something like this 5 years ago, and now all we get is banks asking for the same type of analyses. So, everything old is new again, and Aave Arc was a bit before its time. But Jackie, tell us about technological.
It's great.
Yeah.
I don't think that there is technology as holding people back today. I think it's knowledge and ability to execute around building. And so on the knowledge side, I'd say core teams of financial services are not geared to have the insight and judgment to understand what's being built on a blockchain and how the products work. And so it's hard to both regulate or oversee something as a financial institution when you truly don't understand it. And so the knowledge gap, I'd say, is pretty extreme. And we've been doing crypto for years, and I think one of the things our regulators felt comfortable with is that we understood the products that were on our rails. And so when people were claiming they were being debanked, you could come to Lead Bank, and we were able to work with you because we actually understood the products and had the confidence of the FDIC and the Fed. I'd say the second issue around ability to execute, Michael made the reference about the velocity of the way things are being built and executed on chain. You have to be able to build and execute with engineers that can work in real time and have very quick sprint cycles in order to be able to operate in this dynamic environment. And I'd say a lot of financial institutions don't have that. And scale doesn't matter. Sometimes you can do more with 5 engineers than you can 10,000. And so it's more an issue of how do companies run in financial services where you have 50% of the market cap plus being 50 years older and more. And so a lot of these companies are going to have to reorient around velocity. And so the only real technical issue I've seen in the last few years is that around 24/7, 365, which Jennifer referenced. But having said that, you could adjust around that so that you could manage it and be able to execute within an institution so that you actually could send and release within an institution 24/7, 365. And so that's existed. It's just something that an institution had to build against until you were actually able to use Fed windows that are 24/7, 365, which you can today. And I also think now most companies are quite comfortable with the windows that exist. It's not optimal. So I'd say like that would be the one tweak I would make to make sure that the liquidity is able to be managed and all the counterparties are able to be managed across a dynamic perspective of what 24/7 looks like. You don't have consistency in all the counterparties that exist today. And I'd say companies like TradFi as an example, or the institutions that federate bank deposits, or even on the flip side, core providers, which aren't 24/7 oriented in their mindset of how they do things. And so, my summary would be there isn't a technological problem today. It's a capability, not a technology.
I love that, Sergey.
Yeah, sure. So I heavily echo what Michael described. We are in similar situations with a lot of users. And I think there is a big hurdle to clear there in the traditional institutional world of integrating their existing systems with the chains. I think there's really 3 problems to solve. There's that first problem of the correct integration of the existing systems for books and records purposes, compliance purposes, key management purposes, all these different purposes with the chain, so that the large existing tech investment that was made by there's all these jokes about how banks still run on COBOL. Yeah, that's true. They're still going to run on all this stuff. So you have to make all of that compatible, and you have to make it compatible in an open standard. So you have to make it compatible in a way where, to Jackie's point, you can get 5 engineers to do it successfully themselves. Then the next problem really is, how does the transaction actually work? So, okay, I've synchronized my internal books and records requirements, systems, accounting system, whatever system, and now I have to do a transaction. How's that transaction going to work? How does that operate? What information does it carry along? What does it prove to regulators, and so on? And then the final point where we started mentioning Aave, the new version of Arc is Aave Horizon, which Chainlink is actually the main technology provider for, powering it for cross-chain compliance and a whole bunch of other things. That's where you have a model similar to what you have in banking, where the destination is responsible for making sure that things are a certain way, for making sure that they're not dealing with certain parties, that the liquidity pools work in a certain way. So then the third problem is, how do you get this DeFi community that historically has been completely disconnected from any regulatory anything to meet regulatory standards? And the answer to that is smart contracts, right? So you write smart contracts which automate compliance. You write smart contracts that automate the proving of things to the counterparty as well as to the regulator, as well as to the DeFi team. And so that third problem requires a set of on-chain smart contract standards for compliance, for cross-chain connectivity, and for data into that cross-chain and compliance set of contracts. And then all of that will have to work together, where you'll have to have the existing systems properly synchronized with chains to meet their requirements. You'll have to have the transaction that goes across chains to be properly formed and convey the right information to the receiving chain, and to store the right information in all kinds of places that regulators and counterparties need to look to be sure that their transaction is correct and reliable. And then you need the destination of the transaction, in this case, the DeFi protocols, to have what's called regulated DeFi variant. So the reason you have like Aave and Aave Horizon is because you're not going to make Aave work this way. You need to make a separate version. And so all the DeFi folks need to make these separate parallel versions that are able to interact with all this regulated capital. That's called regulated DeFi. Seems to be that's what we're discussing here, which is kind of amazing. You know, a year ago, I wouldn't have imagined. If you told me a year ago you're going to be at the Fed discussing regulated DeFi, I'd be right, Michael? Yeah. It's a crazy idea, isn't it?
No, I remember what we discussed 2 years ago, a year ago, yeah.
A year ago, right? 2 years ago, maybe, who knows? But sorry, it's a good thing. It's my way of saying it's a good thing. Thank you. So you have to get all three of those things to work. You have to get all three of them to happen. And then it'll all be lots of fun and a blast. And DeFi gets you 8% to 15% on the US dollar. So I can almost guarantee you that when you open the floodgates for people to get that type of yield on the US dollar in a compliant, regulated way, I mean, the yield will go down, but it'll still be high. It'll still be very high.
It's good. It's good that I'm a moderator, not a panelist, because I'm not sure I believe that there should be parallel DeFi systems, but we can talk about that off stage. Because I also think, to your point, it will take away a lot of the benefits of DeFi, including the yield and things like that. I think there are other both technological and compliance solutions we can be thinking about and putting into place. But before we move on to the concept of stablecoins and tokenized deposits, which are actually critically important in DeFi, you know, in all good symbiotic relationships, people give a little bit. It's rarely 50-50. And so the question I have for everybody, and this is just like a quick, which is, you know, does DeFi need to come 90 and TradFi comes 10? What's the give and take that we expect to see? Jackie, do you want to?
I'll start. You know, we've worked with a lot of digital asset companies for a few years, and I'd say the one thing that has evolved but still needs more sophistication around it is that willingness to actually follow US banking law. And so, you know, like a lot of companies that were debanked, you know, there's different qualities of what they were willing to do. You know, some of them were just young and they worked with a bank that had no financial experience. And so they decided to pull back from the digital asset space. Like, that's legit if you don't have the team that's able to do it. But there are a lot of companies that are young and developing that if you actually had to go through the filings that are legally required as a US bank, they are somewhere on one end of the spectrum, which is grossly negligent, or on the other end of the spectrum, just unsophisticated and evolving. And that's not everybody. It's just a group of companies that are just young, you know, developing, trying to grow as fast as possible, and they're just less willing to do what needs to be done in order to operate within the system. And so I have seen an evolution in the last few years where there was this incredible libertarian perspective about how people were going to operate in the DeFi world, and that has evolved, thankfully, where people have understood, and it was probably with the failures around Signature and Silvergate, that crypto companies actually said, like, oh my God, we're like reliant on the banking system. Like, our money markets are relying, our liquidity flows are reliant, so we have to step up our game. And I do think they made incredible strides. And there are some amazing companies in the space that are rock stars in compliance and everything they're supposed to do. But when you have an ecosystem of startups that is highly geared to growth, you know, they hopefully will like hire consultants and go get people who can help them build the bridges in order to onboard appropriately into the financial system. And I think that's probably the thing that requires the most work. And people are largely receptive, not everyone is, but people are largely receptive to it.
Yeah, and as a transition, that was a good transition into this concept of stablecoins and tokenized deposits. And I know there's a separate stablecoin panel, but stablecoins are so critically important in DeFi because most traditional digital assets are very volatile. They don't always have a stable price. There can be large movements, as we've seen even over the last couple of weeks, and stablecoins usually are used as collateral for a lot of borrowing transactions on things like Aave and the like. And so you can't ignore how important stablecoins are, and what Jackie was talking about, even with Signature and Silvergate, you were talking about centralized digital asset companies, but even when you have something like a depeg of a stablecoin, it can have pretty significant ramifications cascading through these permissionless systems as well. But Jennifer, to start, and I think this is really important because there are a lot of misconceptions on it, what are the benefits of tokenized deposits versus stablecoins? So that's the first part of the question. I'd say, what are the main differences? And then how do you see tokenized deposits being used for payments in a permissionless system, if possible?
Yeah, absolutely. So tokenized deposit, we think of that as cash in the bank, right? So it is a digital representation of a bank deposit. And so that stays at the bank. And so that stays within the walls of BNY as an example. And so the benefits of that are certainly cost efficiency, speed, but also liquidity optimization. Still one of the biggest problem statements that exists today in the payments industry is around optimizing your liquidity and reducing trapped cash and really reducing settlement risk. And so the tokenized deposits really help you do those things inside the wall of a bank. But then you have a stablecoin. So stablecoin is, think of that as cash outside the bank. It is backed by some form of collateral, cash, T-bills, what have you, but that can traverse across multiple chains and multiple systems. So we would see that existing alongside other forms of fiat and other forms of existing currency today. So there's a number of use cases. I think both are equally important, but they do different things.
That makes sense. So Sergey, obviously what Chainlink does in terms of pulling data and feeding it into, I'd say, the majority of the DeFi ecosystem makes sense from a stablecoin perspective, but how do you think about doing data feeds for tokenized deposits, especially when the deposits are sitting at different banks?
So Chainlink tries to aggregate data from multiple sources whenever possible. It's one of the reasons the system now secures approximately $100 billion in US dollars. And some of the bigger users have tens of billions of dollars. It's because the data is aggregated from multiple sources in various fault-tolerant ways. With tokenized deposits and these types of things and proof of reserves, you often only have one source of the data. So you can't aggregate across multiple sources. You can create some additional checks. You can do something called securement, where once data proves that the reserves are there, you can decide if something should be minted or not. And this stops cases of over-minting completely. That becomes impossible because the contract itself is responsible for checking whether or not the reserves exist. It's not a people-driven process anymore. It's a smart contract driven check. But the data is often only as good as the sources that you can get. And in the case of tokenized deposits, stable coins, in the cases of more and more real-world assets, the data is often coming from a single source. And so people need to understand the risks that they're taking. There are risk frameworks like the Digital Asset Security Control Principles. Let's say that 5 times fast, huh? DAS-CP. So that's an interesting risk framework where you're considering all the different aspects of risk, the on-chain contract risk, the oracle risk, the data source risk. But generally speaking, I think what's going to be the most useful is that when there's a stable coin or a tokenized deposit or a real-world asset, there's a way to create transparency for the market, right? So the market knows this tokenized deposit is guaranteed by this bank or this custodian in this class of account, with this data source being the only data source, right? And we already provide that information about our proof of reserves for stablecoins, and then the market can make their own risk decisions, right? So the best version of this is actually when you can provide what we call proof of liabilities, proof of solvency, other proofs of the status of the underlying banking partner or banking system. And I think personally that the more information that you provide about an underlying tokenized deposit, stablecoin, real-world asset, and once you provide that to a market that's sufficiently developed, where people are assessing risk because there's enough value in there to care about risk, well, then the stable coins and the tokenized deposits and the real-world asset that prove things at a higher level and are actually built in a more de-risked way will be more attractive, right? So that's just that's the blanket assumption we have. And so our goal is to build systems that, just like blockchains create transparencies within the block, we want to create transparency of all the corresponding systems that put the information into the block, such as the data source in this example.
Makes sense. A few different questions, and I want to make sure there are really good audience questions that are coming in through the Slido, so I'm definitely going to save time for those. But Jackie, two different pieces. One, can we ever use tokenized deposits as collateral in DeFi? And two, can you ever see banks plugging into DeFi for liquidity provision services?
I think there's always an always. I think tokenized deposits, just in the way that, ACH is a messaging protocol that was started 50 plus years ago, tokenized deposits will be, messaging protocol for storing banks. It's as simple as that. Like, money is largely digital today. Like, the definition even of what fintech is largely blurred today because, it's a digital manifestation of money and the movement, storage of money. And so as it relates to tokenized deposits, it's really just advancing digital technology around what a deposit is and adding modern technology around messaging, identity, and programmability around the idea of a deposit. And so I think it's a technology that's going to be used. I think we started to see it, BlackRock, when they launched their ETF, was probably not tokenized deposits, but you could see the train coming down the line when you started to see asset classes get tokenized. And so it's just a matter of turning any kind of asset class into a digital messaging protocol. And so I think banks are going to use it broadly as a technology. How long that takes, say, is a massive question, just because they don't have engineers, and they'll probably start with outsourced technology of other infrastructure providers.
Yeah, and I was going to say, Michael, you probably have something to say about how to bring this all together too.
Yeah, I mean, I actually have some maybe slightly controversial observation on all this. We've been engaged with both stablecoins and tokenized deposits for the last couple of years. Currently 10% of all USDC and USDT is actually going through Fireblocks, so we have pretty good statistics. But we've also been engaged with quite a few banks on tokenized deposit projects since 2022, for example, with ANZ and the National Australian Bank in Australia. The main issue that I see with tokenized deposits on public blockchains, there are successful projects on private blockchains, like the JP Morgan coin, right? And back in the days, there was the signature that was also a tokenized deposit. On public blockchain, it's actually unclear what happens when when it goes from first party to third party, and what is the liability of a bank. It's actually not being established, and that killed, from what I've seen, every project or every bank project that was trying to do tokenized deposit on a public blockchain. Now, this is not a technological issue. It's a regulatory question that no one knows how to answer today. And that actually, I think, basically puts the true limitation of how tokenized deposits can interact with the DeFi primitives that we have today.
I agree. As a lawyer, the regulatory sirens were going off when I thought about how could we use tokenized deposits in DeFi. Okay, so to make sure we have time for these few questions that we've gotten, which are great, I just want to finish off going down the panel as quickly and concisely as you can say it. What are your recommendations for the Fed to prepare for the payments landscape as it evolves to converge with DeFi?
Yeah, so I would make the existing Fed infrastructure compatible with the stablecoin, tokenized deposit, and other payments infrastructure. I would make sure, I would ask the Fed to think about making the guidance very clear on what the risks are in relation to stablecoins, tokenized deposits, and these things, so that the payment landscape can grow, because the payment landscape represents essentially the buy side of the digital asset economy. and then the buy side makes the sell side, the issuance side that makes the tokenized funds more attracted, right? So I would look to make your existing infrastructure compatible, and I would look to create clear guidance that manages risk appropriately to make sure that the stablecoin and tokenized deposit, the payment side of the digital asset economy, can grow successfully and can grow successfully out of the United States more than anywhere else.
I would actually tread carefully and watch and iterate as we go over the next few years. There's two reasons. One, the intersection of AI, fraud, reversibility. We are at a moment in time with AI where we don't actually know what is going to happen from a fraud point of view. And I think the reversibility and the opportunity for fraud vectors is rather extreme. And so I think, you know, it's always going to be great until the moment when on a wide scale spectrum, you know, like everybody's grandma was just defrauded because of deepfakes. And so I think this intersection of trying to be super innovative, enabling crypto and new payments technologies and AI is worthy of just being incredibly, incredibly cautious. And I know that's very like nanny moment for everyone in the room since we're at an innovation conference. I just think the better strategy is slower and steady and watching it as opposed to trying to explosively change everything and not having managed this intersection of AI, which I think is still largely untested, unknown, and asymmetric risk into the system.
I tend to agree with both observations. The only thing that I would say is that there is still an economic question that comes quite a lot, especially in discussions with banks, right? That it's a question around how, well, the Federal Reserve eventually is responsible for the banking system in the United States, and at the end of the day, there is an economic question that comes pretty often with central banks around how stablecoins can, or can impact the credit in the overall system. And I think that this question also needs to be kind of further researched, and that there will be a clear guidance and opinion on how this all going to play out, because clearly it may or may not have big business model implications for banks.
Yeah, and I would agree with everything you said. I think 4 things. First is just continuing to upgrade the existing infrastructure 24/7, et cetera. The second is standards and setting standards across formatting, just continuing that work, I think is really important as you look to integrate. I think third, Jackie, you said it is on fraud. Faster payments result, banks have to, and everybody else in the market has to adjust more quickly, right, to assess fraud and to make fraud decisions. So I think continuing to really lean into the fraud topic is very, very important. And then I think finally, and we talked a little bit about this earlier, is look, faster payments and stable coins and tokenized deposits, like you can access liquidity faster, but then you have to have the associated kind of standards around stablecoin redemption as well as liquidity policy to support that.
Amazing. Okay, there's actually one question for everybody, and we have a little over 5 minutes left. So concise answers, but everybody gets a last question. So this question is from Congressman Foster for Sergey. Your internal Oracle syncing network does not use permissionless blockchain. Does this make you a trusted third party and single point of failure?
Yeah, so our system uses multiple independent nodes, just like blockchains do, and it does work with public chains as well as private chains. Generally speaking, those nodes can be configured into groups for a specific network that meets the requirements of a private user or a public user. So for example, if the Fed needed an Oracle network to do something specific, the Fed could choose the nodes and the conditions under which the nodes operate for the Fed-specific Oracle network. And that would be the risk that they choose in configuring that Oracle network. The public Oracle networks are configured similarly to how public chains are configured, with many node operators. Many of the node operators of Chainlink Oracle networks are also the node operators of any public chain nodes. So the Oracle network, there's over 1,000 Oracle networks running in the Chainlink standard. So you can configure an Oracle network to meet your requirements for compliance, location of the nodes, and these different requirements.
Okay. Jennifer, this question is for you. How would a revocable mechanism realistically work without undermining the decentralized, trustless nature of blockchain networks?
Yeah,
This is an easy one just to...
Right, just no problem. I mean, that's exactly the question. I mean, technically, right, Fed chips are final, but you can in fact like revoke them if there's an issue. You can call the bank, et cetera. And so there is a process that exists to protect consumers and to protect banks and corporations around that. And we're just going to have to continue to partner in the industry to think about how we answer this exact question in the digital asset infrastructure.
Makes sense. Although I find reversing bank transactions is not as easy as just calling your bank. Okay. Jackie, this is for you. In TradFi, settlement finality depends on trust in institutions, and in DeFi, it depends on trust in code. As they converge, who should provide the trust anchors?
Oh, I love that.
I love this question.
I feel like we should have Camus in the room to answer some of these questions. So, I mean, trust is trust, and I think every institution is responsible for their own code, regardless of whether they're theoretically supposed to be a traditional financial institution or a modern digital asset company. I don't think there's any difference. And I think over time this distinction will go away. I made the comment earlier, what is an ACH? What is any kind of money movement? It's digital money movement that's sent through messaging systems. And so this distinction is largely going to disappear as digital asset regulation gets instilled into the US economy and US financial institutions, because it will have a different but somewhat comparable set of regulations, and it'll operate with KYC, it'll operate with a lot of the same trust dynamics that are established. Now, hopefully, the biggest change will be using modern systems, like modern identification systems and modern technologies that we have today. I think that's still a problem, just because so many institutions, it took 10 years to be able to use DocuSign at so many institutions. And when you get those red emails from banks that say this email's from external, stuff like that, as an emblematic kind of funny example, will have to evolve so that identity can be deployed in a modern way. I mean, it exists today, and we have CEOs in this room who are experts at identity. And so it's up to institutions today to be able to adopt those rules. And I also find that anyone who says, oh, I can't do that because it's not compliant, it's a crock. It's like a total crock. When you actually go push on financial institutions' compliance teams, you're like, show me that law. Show it to me. It's not true. And somehow nobody edited out the garbage to deal with modern systems of today. And so I think when people edit and put in modern identity, you're going to be able to have modern versions of trust.
Great. Whenever people use compliant, when we're talking about DeFi, I'm always like, compliant with what? Just tell me with what. Okay, Michael, last question. What are practical strategies that you've seen that will close the gap between legacy payment systems, tech, and processes with digital assets?
In 1 minute.
Yeah, in 1 minute. Very simple. Also a simple question to close it out.
Okay. It's definitely a 5-hour seminar. But look, at the end of the day, I think that the truth is that there is just a lot of education that needs to go to the teams that are currently working on that in the traditional financial space. And I think that there are a bunch of enterprise-grade partners, providers, vendors, however you want to call us, whether it's like us, Chainlink, Chainalysis, a lot of folks that have built this muscle over the years, worked with institutions, and invested just hours over hours over hours to basically bring the operations team, the compliance team, the technology teams, all those folks, and educate them on that. And it's also extremely important to bring the executive team on board in those organizations to understand it. I would actually argue that in most cases, the final blocker is basically kind of getting the CFO, the chief risk officer, those guys over the line. And by the way, the most important thing is actually to give them. That's what I actually tell now all the people, like download the wallet, download the MetaMask on your phone, and then I send them USDC, and then I tell them to send me back the USDC, and that's, I think, like, where the light bulbs go.
It's a reversible transaction. Just
It
kidding.
is, it is a reversible transaction, yeah.
Well, thank you very much again to the Fed and Governor Waller and everyone here who put this together. Thank you to these amazing panelists who are clearly experts in everything they're working on and creating the bridges that we need to bring TradFi and DeFi together.
So a big thank you. So a big thanks to Rebecca and our panelists. So I have to share that if I had created a bingo card for today, I would not have put COBOL on it. So thanks to Sergey for bringing that up. So we're going to start with a 30-minute break before our next panel. There's light refreshments out just outside the hall. In addition, if you have to make a call, there are a couple of rooms that we have available, and to find them, just ask somebody with a blue stripe on their name tag. And we are going to be mingling around and right outside the door as well. We will be back at 10:50. All right. So I can tell from the amount of vocal noise coming from the hallway and in this room that everyone had a great opportunity to meet others, engage with old friends, and so that's wonderful. We'll have some additional opportunities during lunch and during the next networking break. We're back for our second panel, and we're going to be talking about stablecoin use cases and business models. As a reminder, questions will be open during the entire panel, so please use Slido for submitting them. And now I'm going to introduce our moderator, Kyle Samani. Kyle is a co-founder and managing partner at Multicoin Capital, an investment firm that specializes in crypto assets, tokens, and blockchain companies. I'm now turning it over to Kyle. Thank you.
Awesome. Good morning, everyone. Thank you all so much for being here. Governor Waller, thank you so much for organizing everything for us all. In order to kick things off, probably be good to do a quick round of intros. So, gentlemen, please take it away.
Hi, my name is Chad Cascarilla. I'm the CEO and co-founder of Paxos. We are a blockchain infrastructure company that both provides crypto infrastructure as well as issuance infrastructure for stablecoins.
Tim Spence, Chairman and CEO of Fifth Third, pending the closure of the merger that we recently announced with Comerica. Will be the 9th largest bank in the U.S., but apropos to this discussion, we are a much larger payment facilitators. We facilitate about $17 trillion a year in transactions, of which the Fifth Third branded business is the anchor tenant, but we're fortunate to do business with several people who have been on the stage today, in addition to many of the other leading fintechs and third-party payment processors.
I am Fernando Terres. I'm the co-founder and CEO of DollarApp, which is the leading fintech app for the mass affluent demographic in Latin America, backed by the best investors in the world. And with more than 1 million users, we allow them to dollarize their capital, grow it, and be able to transact globally, leveraging on stablecoins. Prior to that, I was the leading crypto at Revolut, and I also held a prominent role in helping build its growth engine, as well as taking its path to profitability.
Heath Tarbert, president of Circle, we like to say the world's largest regulated stablecoin issuer. We're issuer of USDC, and we also have a number of other products and blockchain technology. In a prior life, I was Assistant Secretary of the Treasury for International Markets, a representative on the Financial Stability Board, and chairman of the CFTC.
All right, guys. So let's jump into this. I think the intended framing for this dialogue, this is really supposed to be a conversation about technology. On stage, we have an issuer, a bank, and an app. So I wanted to try and cover kind of all perspectives for all of this. We will jump in with you, Fernando, first. You are B2C directly and close to a lot of end users who are using stablecoins every day. What are you seeing in terms of demand, usage patterns, feedback, across Mexico versus Argentina and Brazil? And if it'd be really helpful if you could share one end-to-end journey that shows why it's simple, fast, and useful.
Cool. Effectively, we're live in 4 markets, which are Mexico, Argentina, Colombia, and Brazil. And the use cases are pretty different country by country. In some cases are more around the store of value idea. So imagine you're a Colombian person, you want to dollarize your savings. But there's also elements on the transactional side. So imagine you're a Mexican person living close to the border and you'd like to travel with your family to the US, right? And you want to be able to spend internationally. Or also if you're a backend engineer living in Buenos Aires and you want to work for a company in Europe, in the US, and receive your payroll. So those would be some of the use cases which are pretty consistent across all of the markets. When it comes to the flow of funds, so to speak, or how we structure it, we have locally regulated e-money licenses, or we partner with them. And then, of course, with our crypto entity, we execute the rest of the flow. We're also principal members of both MasterCard and Visa. So the way we try to run the company is having these pools of capital, sometimes in fiat, sometimes in blockchain, to be able to bridge the world, so that we as product people swallow the complexity, so we can give the customers the simplicity and the benefits without them having to go through the complexity.
And Fernando, follow up here. Based on that journey, I guess you've been iterating now for a while. What's been maybe one major change in product or go-to-market that you all have learned from hearing real feedback from customers?
Well, I guess the first one I kind of mentioned already. Like perhaps the intuition could have been just store of value. But it turns out that transactional matters, right? So that's one of the counterintuitive ones that allowed us to actually dip into the transactional piece of the equation, which is interesting because the more use case you can serve, the more times you can bring your product to the customer, right? And then the second one, which kind of correlates to this one, is the fact that many of our customers are actually on the mass affluent side of the equation. So people who travel, people who work in technology, in finance, people who save, who invest their capital. So probably traditionally, most of the fintechs in Latin America had gone after the bottom side of the pyramid in terms of wealth, and perhaps we're penetrating from the top. So starting with the top 30% of the demographic pyramid, I would say.
Got it. All right, next let's move maybe over to Tim. Tim, as a bank here, you offer a service, which is the utility and the benefit of stablecoins. What are some of the problems that your customers, either consumer and their enterprise finance treasury teams, are trying to solve right now?
That's a great question. And I think maybe I'll get there, but I want to make a couple of points here just based on some of the conversations we had on other panels, because I think it's instructive as we think about pathways for innovation, where to look. Like, one of the rules that we use at Fifth Third is don't unsolve solved problems, okay? And I was listening to the discussions about interoperability and discounts and otherwise, and I couldn't help but think back to Thompson's banknote guide, which at least the folks from the Federal Reserve will remember existed in the US during the free banking era prior to the presence of the Federal Reserve, where individual banks had to figure out how to discount notes that were issued by other people. And I think the end outcome there, the conclusion there, was that we were better off with a single currency that was valued at par. That would facilitate commerce. So our focus has been on looking at the solutions that are in the market and finding ways, whether it's through partnerships or just through introductions in places where we need to provide them, to utilize things that can become industry standards. So, our clients, when you look at the issues that they face, we're principally U.S. domestic. But we have a huge manufacturing base because the legacy footprint of the bank is Midwest and Southeast. So moving money across borders is a significant issue today. That's a problem that we solve by referring business to other banks. And as a matter of practice, another rule we try to follow is don't enable your competitors. So we have spent a great deal of time in the stablecoin ecosystem looking at ways in which we could utilize stablecoins to solve the interoperability issues and both the FX risk associated with the delay in clearance and the need to work through another financial institution to move money overseas. I think, and that, from my point of view, will be the first and most powerful use case for the Fifth Third brand. The more interesting things to me, though, have to do with the sort of infinite divisibility of stablecoins and the programmability and the things that we're going to be able to do through the business that we have as an infrastructure provider, a little bit like Jackie, to leading fintech companies and others, to help them function in a world where agentic commerce is a material share of the economy, and where we can do more and more, whether it's for compliance purposes or to prevent fraud, or just to facilitate the linkage between contractual terms and payment settlement with the programmability of stablecoins.
Next up, Tim, another follow-up for you here. Given a lot of these outcomes, how do y'all think about buying versus building?
Yeah, my view is there are a handful of truly global banks that probably would benefit from having their own stablecoin, like that facilitates book transfers. So if you're JP Morgan, if I were JP Morgan, I would be doing what JP Morgan's doing. But there are like 4,996 banks in the US that aren't JP Morgan or Citigroup or Bank of America or Wells Fargo. And for the rest of us, it's important that we move toward something that approximates more of an industry standard solution. That's the way that you solve for interoperability from my perspective, as opposed to layering more technology onto it. It's also how you solve for adoption, right? The tech here is obviously better than 150-year-old payments rails. Like, forget COBOL for a minute. Imagine what the FedWire was originally built on, given the comments that Governor Waller made at the beginning of the session. what doesn't exist today in most cases is the governance, right? And the governance layer is a thing that multiple parties need to be able to agree on here. And then we need to be able to drive user adoption. Like, Zelle was late to the party in peer-to-peer transfers, but it dominates today in terms of total volumes. And the reason it dominates is there's a single brand. It is and a governance mechanism that is embedded into something like, I think they have 80% coverage in DDAs in the US at this stage of the equation. And it therefore made it much easier for people who weren't in college and splitting pizzas to move on to a world where they were sending money P2P via an instant payment rail. And partnerships make that possible in a way that going back to a world where we were issuing our own currency probably wouldn't.
All right, next up, let's move to Chad. Chad, from the issuer operator seat, when should a bank build, partner, or just distribute?
How about now? There we go. I think it's difficult for any individual bank to issue, just like Tim was mentioning here. Even for the largest banks, I think it becomes difficult because the same reason Tim also mentioned, he doesn't want to fund his competitors. That's one of his number one rules. And I think you end up in a world where that would be the case if everyone started to use someone else's stablecoin. That's kind of the beauty of it, is that because it's not just contained on your own systems, but it's moving into other people's systems, you have to really create a value proposition to enable others to want to enable that. And so if you're the largest banks, you might be able to, but from everything I've seen, actually some of the largest firms all are trying to figure out how they can do this together. Maybe a la Zelle, and there's a Zelle bank effort. There's a global bank effort that was announced, I guess almost 2 weeks ago now. And so that's what we have seen, is that, and I'd maybe mention a third point, which is there's a little bit of a skittishness because some of the large banks don't want to necessarily end up having their own token that could be facilitating a cross-border illicit activity, and that there could be brand risk from that perspective as well. So that has all, I think, ended up pushing institutions to try to think about how can they use something that is brand agnostic, that has the interoperability, that allows them to be able to capture the economics. And I think there are a number of different ways you can do that without having to build it yourself. Obviously, building it yourself could create brand recognition. It can create better economics if you're able to create a way in which the market would create widespread adoption. And that's where there is this push and pull of the network effect that's inevitable. Largely, stablecoins today, and I don't certainly believe this will be the case in 2 or 3 years, are for the crypto ecosystem. And so can you get it in all the wallets? Can you get it on all the exchanges? Can you get it in the DeFi protocols? Can you enable it to have the right on-ramps and off-ramps through all the other parts of the payment system? Visa, MasterCard, the merchant acquirers. That's a lot of different gating points, and all of those gates have to say, yes, we would like to be able to accept this. And that means you're not going to end up with thousands of stablecoins that will be a rail. I think you'll end up with maybe 2 to 5 stablecoins that could be a rail. You can end up with thousands of stablecoins that look like a prepaid debit card or a co-branded card. I'm old enough to remember MBNA, who basically built almost 20% of the credit card market based off of having, Notre Dame credit card. I had one of those too when I graduated. And so you can imagine having lots of choice, almost infinite level of divisibility because of the technology and because the Genius Act and blockchain have set standards and set interoperability. So I can see there being so many different types of stablecoins, but not really so many stablecoins that ultimately you will use on a global basis. And that's what I think every institution has to think about, no matter how big you are. Where do you want to be? Are you large enough to maybe try to make a run at that? And most institutions aren't, so how could you instead find a way to work cooperatively?
Can I add one thing to that? Because I think I totally agree with the point you were making. I was sitting in the audience earlier gritting my teeth at the term TradFi every time it comes up, because Fifth Third is an old bank, that's true, but it's the least interesting thing about us. So I am, at the moment, I'm going to propose that we go with scaled fi versus DeFi. At least there was one other bank in the room because there were some claps over here. And I know Jennifer feels the same way. But the point you're making, Charles, which I think is so critical, and the reason why we probably do need to arrive at a standard and have a couple of different networks, is in order to scale, you can't have an artisan model. Like, you have to have an industrial scale model, you have to have agreed upon governance principles, and you have to be able to support lots of different endpoints. And there's just no way to do that when you have so many different potential solutions in the market. So I totally agree.
Yeah, I'll just add my own little commentary. As someone who is a very active user of DeFi systems, I think most folks trying to get into the space don't appreciate the nuances of the complexity of the DeFi protocols and the on and off ramps and the wallets and making all those things work. It really is pretty difficult from a user experience perspective. All right, next up, we're going to Chad and Heath on this next one. What are the top 2 bottlenecks at the perimeter? So things like KYC, AML, wallet UX, things of that nature. What are those 2 biggest bottlenecks? And then what's fixed and what do you think is going to change in the next couple quarters?
You sure? I feel like we should give you a chance to talk.
All right. Well, my wife doesn't always say that. That's it. But so look, at a high level, when I think about frictions and sort of what are the things that are barriers to stablecoin use case, right? Or just using stablecoins, I'd say there are really 2 big buckets, 2 meta buckets. The first is the thing trusted, compliant, and transparent? In other words, do I need the Thompson's banknote guide or something like it to know whether or not I'm actually going to get my dollar back, right? I think the Genius Act largely solves that problem, particularly as it's implemented, because all stablecoins aren't equal and all stablecoins aren't stable. So I think making sure that we have payment stablecoins that actually are held to very high standards is job number 1. Good news is this country's made a very important decision on a broad bipartisan basis, and I feel like that problem is being solved. The second aspect, though, is assuming the dollar's solid, the stable coin is solid, is it actually useful? Does it have utility? Does it have liquidity? One example I like to give is, suppose at the end of this conference, the Federal Reserve Board says, good news, we're going to give everybody money to buy your dinner at Reagan Airport. But we're not going to give you a Federal Reserve note. We're going to give you 50 euros. Would you be able to actually buy your dinner at Reagan with euros? It's a perfectly solid currency. It's an outstanding one. It holds its value. But it's not necessarily have utility in certain settings. And so 2 big barriers to utility and liquidity are, number 1, and this was mentioned earlier, the banking rails. Making sure that you can move in and out of fiat currency back into something like a USDC or a Paxos stablecoin as quickly and seamlessly as possible. So Circle, for example, has spent years building out this network of reserve banks and partner banks for customers. In fact, we're pleased that Fifth Third is a part of that network. So that's the first thing. And then the second thing for barriers would be the blockchains themselves. USDC is natively on 28 different blockchains, but it's very difficult to move currencies among blockchains. We have something called the cross-chain transfer protocol. But again, if your stablecoin only works on 1 or 2 blockchains, again, that's another barrier point.
And maybe what I'll add is, I maybe break it into 2 categories. One is some of the friction in the stablecoin world is how do you get back out of the stablecoin world? And he was describing a lot of those, especially when you live in a world where you have to move money 24/7. And so this adds quite a bit of complexity if you think about, well, someone shows up with a stablecoin, they want dollars, and it's 11:30 on a Friday. How do you make that possible? And there are plenty of examples of that. And then on the other hand, it could be, I'm in Asia and I'm putting money to work and I want to make sure that I'm able to get a stable coin, and you're tied to US banking hours. And so there's many different types of complexities around interacting with the traditional financial system while being able to have an effective stablecoin product that works. The second component is exactly what Kyle was describing, which is I'd say DeFi and crypto is still not abstracted away enough where it's solving just the problem as opposed to requiring you to actually understand the underlying mechanics. To date myself, I kind of think back to trying to get on the internet, and it was like trying to get on when there was this thing called Freenet. And you had to like dial up, and you put this like receiver on a thing, and you got some weird noises, and you could get like a little line of text that would come down. By the way, like as absurd as that sounds, that's actually not that unusual when you kind of go through the DeFi ecosystem. And it really shouldn't be that way, or frankly, just crypto in general. I think that'll all get abstracted away with great consumer products that allow you to solve a problem. Just like, no one knows how the phone works, or at least almost nobody does, but yet everyone knows how to use it. Crypto, blockchain, DeFi, stablecoins need to be just like that, which is I think what Dollar App is, for instance, doing, which is just making it so I can solve my problem. Is I want to be able to move dollars, I want to be able to hold dollars, I want to be able to have it happen instantaneously. It needs to be that simple at all times. There are so many different complexities depending on exactly what your use case is for stablecoins still. And so I think those things are all problems that can be easily solved. People are working really hard at solving them, and I think that they will absolutely get there. There are large firms like PayPal, which launched a stablecoin several years ago, and they were one of the first to come out and say they wanted to launch it, being a scaled financial institution. We don't want to call it, yes, you're welcome. And I don't think we call them TradFi. They're a real fintech company, really huge in terms of their scale. And they launched a stablecoin. And that's an example of someone being able to take this technology and be able to move it into the traditional system and be able to try to solve problems in a way that you couldn't otherwise. That's how I look at what can happen here.
All right. Next, I'm going Heath. You got a solo one. What are some programmable features, maybe things like allow list, conditional transfers, and others that are going to make stables invisible in workflows in the next 6 to 12 months? Hopefully, we can overcome some of these challenges.
Yeah, the whole goal. I was thinking about this the other day, and I remember about 20 years ago, you would talk to someone, a family member, and you'd say, well, we should go out, and we should buy this thing, and someone would say, well, I'm going to go on the internet and buy it, right? We don't say that anymore. We just buy it. It's just assumed. And so we're going to get to a point where stable coins themselves are just floating around like any other form of electronic money, like credit cards, debit cards, most of which are, by the way, are not legal tender. And so what are some of the programmable use cases that sort of we're thinking about? Circle is focused on all use cases, but particularly thinking about enterprises, right? And so I'm often overseas. I'm talking to, let's just say, a Korean manufacturer who wants to sell goods overseas to Latin America. It takes 5 days for the money to move, and sometimes takes, is extremely costly. So you can imagine a scenario where all of this is built in, and the moment the goods leave the factory floor, through smart contract technology and programmability, the money is automatically sent, or when it's received on the other end. So trade finance and just trade in general is something that could be supercharged through stable coins and the programmability that it offers. Another thing we're seeing is treasury functions, right? And even for scaled financial institutions, we have a large scaled financial institution that is actually using USDC, for example, to move money inside the institution across borders. And so again, a lot of that is programmatic, and the features matter. I will say that in some ways, we need more than just programmable money. We also need the underlying rails to be enterprise grade. So one of the things that Circle is doing is we're reading the CPMI IOSCO paper, we're reading stuff from the BIS, and we're saying, what are the barriers to large enterprise use of blockchains so we can actually make programmability really effective. And so we're developing something called ARC, which is sort of an enterprise grade L1 blockchain that has, sub-second deterministic finality that makes it very, you send the money, boom, it's done. You don't have to wait. There's no probability. There's no 51% attack concern. Using something that's very stable like a USDC as gas, and other features as well, including privacy layers. So it's just very important to say you got to combine the programmability with the underlying infrastructure as well to really unlock these use cases.
If I can just jump in on that one. I think there's a lot to be done here. I think one point of encouragement for anybody who is building, like we have a fairly sizable business essentially selling software, like subscription software to corporates to automate payment workflows. About a third of the total revenue the bank does annually now is attached to people who utilize software to eliminate some manual step, whether it's recon or payment scheduling or otherwise. There's a lot you can do with programmability that is technically better than people using bill pay services to schedule a payment, right? But it has to be much better in order for people to change the behavior. Like the law of good enough works against any new technology, because if the existing method works well and it doesn't cost much, and especially on the consumer side of the equation, most payment initiation is free in the US, you have to be able to demonstrate some significantly better value. So demonstrating programmability, showing people, hey, you can program the payment so that it moves consistent with your payment contract is not meaningfully better than just pre-programming your whatever sourcing software you're using to initiate an ACH instruction at the point in time when you've hit the date that the payment is due. You have to actually focus on the integration, right? That is the place where you can improve a step. So instead of having to pass contracts and have somebody sitting, in a bullpen somewhere working AP files, that there are agreements that are standardized at the time of the procurement that then pass straight through to the financial institution or the wallet provider that then automate. It's just that's the step we're going to have to take here, because just because we can doesn't mean anybody will.
All right, and then I think we have a follow-on here for Heath. What's actually production ready now for enterprises? And specifically around things like illicit activity detection and where are false positives still going to bite us?
Yeah, so the whole area of making sure you're on something that's trusted, right, is in many ways critical for enterprise adoption, right? And enterprise is going to is going to be extremely hesitant to risk its reputation to go on a blockchain where potentially North Korea is a validator. Right? And so there are a number of factors like that we're taking into account. So for example, ARC, the blockchain that we're creating, will actually have permission validators. So everyone will be vetted in advance. And also making sure that the institution that you're getting the digital assets from has an AML CTF program, it's compliant with the Patriot Act, all of those things matter.
All right, next up we're going to interoperability and orchestration. This one's for all of y'all, so feel free to jump in. Keep it clean out there, boys. Where is interop already good enough? And where is it brittle? What orchestration layer or layers are going to enable a truly tech-agnostic experience?
Actually, I can get started from the consumer standpoint. At the end of the day, it's not so expensive to maintain some liquidity buffers to orchestrate, because even today, it's still pretty aggregated. The question is, what happens if we end up in one of these ridiculous situations where it's so atomized, but right now, from the consumer standpoint, I would say we don't see that being a big issue. You need to hold some liquidity buffers, but again, you don't really have FX exposure. You have some credit risk that you need to manage, but we haven't encountered that being a big problem. No? Keen to see on the scale side, how do you guys perceive it? But on our end, it hasn't been a big deal.
Given the interest that we express in cross-border payments, it's the on-ramps and the off-ramps. It's the point you made earlier about the need to cobble together your own ecosystem if you want to move money utilizing stablecoins today. The actual use of the rail is much easier than getting money in and then getting it out in another jurisdiction, ensuring that the person that you're paying has the ability to accept it and to convert it back to fiat. My big fear, I think there are lots of really interesting things that can be done with tokenized deposits, but that's the place where I think the interoperability issue is the biggest. If we can land on a handful of, call it standard stablecoin payment rails, I don't know that interoperability is a problem so much as it is just getting to a point where the adoption on both sides of the network, on the send and the receive side, are native as opposed to through a third party and then a transfer.
We're in a bit of a strange interregnum where the Genius Act has passed, and you can be forward-looking Genius compliant, but you aren't Genius compliant today. And so that's actually created a huge proliferation of stablecoin issuers from a white label side and otherwise. And so I actually think if you had a moment of risk where something could go wrong, it's probably now, between now and 18 months from now, because you have so many different firms that are operating in ways that may or may not end up looking like they've aged well. But I do think that once Genius comes into effect, when the rules are put into place and everyone is have to follow them, which I guess gets you all the way to 3 years from when it passed, you're going to have a clear set of rules, and that should create a level of fungibility that can be relied upon as long as the standards are widely enforced, and I think also adopted in a number of different international jurisdictions, so that you create this capacity where it is truly cash and cash equivalents. I think that's where we'll go. And so between blockchain and standards, you do create a capacity to have interoperability in a forward-looking basis. You don't today because stablecoins still have counterparty risk to them, depending on exactly how they're constructed. Most of them still do. And certainly a lot of the new ones also do as well. And so that's where there's a real interesting dynamic that exists right now. I think that also, and this is really, I think, Tim's point, there is a lot of complexity around having to be able to manage that liquidity because those are not the same liabilities. They're almost, in some ways, akin, though not the exact same thing as a deposit, because you have the counterparty risk related to them. I think that'll all get worked out over time, and we'll get to that end state where I think that will lessen maybe either the capital that you might have to hold against stable coins, the amount of risk limits that you would have to put into place, the counterparty capital charges that you might need to carry. But I don't think we're there yet. So we're getting there, but there's a lot more work to be done yet.
Maybe you asked about orchestration. I think, and this goes to sort of Tim's point about sort of not unsolving problems that have been solved. A lot of the domestic payment system works rather well. There are obviously improvements that can be made, but once you step outside U.S. borders, it becomes a lot more complex. So one example of orchestration is something we've created called the Circle Payments Network, where we have institutions on various sides that are orchestrating FX flows using what Governor Waller has called the stablecoin sandwich. But right now, to send money to Brazil from the United States or from the European Union to the United States, it can take up to 72 hours going through various correspondent bank accounts. We've been able to get that down to 72 seconds using basically fiat on either end and then the stablecoin rails in between. So it's a great example of where orchestration, as you asked the question, actually can make a difference to solve a problem that is a real barrier to use case. The other point I just want to think about is tokenized deposits. We've mentioned it a couple of times. There's a couple lines in the Genius Act that just gives a scant reference to it, but this country has never really thought about tokenized deposits and the potential impact on the banking system. And as a former regulator myself, I'd ask the question, I think you used the term, used 996 banks in the United States. Yeah. If in fact 5,000 banks in the United States, many of which are community and smaller banks, immediately overnight tokenized their deposits, they moved at the speed of the internet 24/7, as a bank regulator, I might be a little concerned about that, right? And so I think if we are going to go down the road of tokenized deposits, unlike stable coins that are backed one-to-one with very high-quality liquid assets, if we're using the fractional reserve banking system, which is subject to deposit insurance, the discount window, and essentially a government intervention model, and we're going to tokenize that and move it quickly through blockchains, I think more public policy work should be done.
All right, and then we're getting to the last question here before we open it up for Q&A. This is for all of you all, so please jump in. Great tech always lets you do old things better and some new things that you couldn't do before. Could you all each please give one example of a use case that you think are going to become possible using stablecoins in the next 1 to 2 years that are maybe not possible today? And maybe as a bonus if you want to get AI agents in there somehow. But y'all go for it.
I guess I can get started, but it was kind of mentioned already by Tim before, but the idea of having a large financial institution initiating a transaction on blockchain is literally a game changer. because you suddenly move into 24/7 money movement made instant, right? So I think that would be like the biggest change to expect on that side, I would say.
I'm really excited about the potential for fungible collateral that can move around the world and across exchanges and otherwise. We have a couple of clients who run large exchanges who are exploring that sort of mobility, and it would make a material difference to the institutional investors and counterparties that trade on those exchanges.
I think one of the interesting components is that if you really kind of look at the dollar on a first principles basis, it's basically a wrapper. It's kind of a wrapper today for government securities, maybe some gold, some other things that are on the Fed balance sheet. It's a wrapper, but essentially a stable coin is an even smaller subset of what the dollar is. It's basically only cash and cash equivalents, only T-bills, only overnight repo, and some bank cash. And you can imagine once you start having tokenized treasuries and tokenized repo, as Tim was saying, you can actually completely change the way in which the collateral mechanisms work for how you could run repo programs, how you'd be able to instantaneously be able to create a stablecoin on chain. A lot of the frictional elements of stablecoins start to disappear. It actually becomes quite democratized, and I think there's so many questions that come up around, well, you can't really have stablecoins pay interest, and I think the Genius Act struck a good compromise there. But in some ways, I think that really just becomes a bit of a sideshow when you have tokenized treasuries, because you're then able to immediately swap in and out of something that's giving you yield into something that isn't giving you yield. And so then, you can have that artificial construct, which makes sense in some sense, but that's not really the ultimate end space for what stablecoins are going to look like, or even the financial system will look like, because you can have the underlying assets themselves be able to move just like a stablecoin moves.
One area you asked specifically about AI that I think about, and this may be beyond 12 to 18 months, but there are people right now that are thinking through these issues and working on them, is sort of the economics of AI itself, right? If I have a website, an encyclopedia, and AI is visiting that website, calling data from it, it's possible in the future no one will visit my website anymore. So I'm a producer of data, I'm a producer of content, and at some point you've got to interact with the AI and perhaps charge something, and I can't help but think that agentic payments plus programmable money, stable coins, could play a role in that whole new emerging economic system that we're still trying to figure out.
All righty, and now we'll jump into Q&A. Our first question here, of course, is coming from Anonymous. This one's for Charles and Heath. Fast forwarding a decade, how do you think proof of reserves will work, and how will it be different from how it works today?
Well, the good news is we've got the Genius Act. That'll be implemented. So we'll have the transparency that's there. But I think if you potentially combine that with AI agents and zero-knowledge proofs, there could be something there as well. But right now, the Genius Act solves that through transparency, through audits, or sort of the old-fashioned way. It's entirely possible there could be other ways of making sure that those reserves are confirmed as well.
The way it works today is I think Circle and us, we do monthly attestations. We have KPMG, and they look at what's in the bank accounts, which is actually the hard part, and then they look what's on chain, and they say, yes, that matches up. And you could try to do that more frequently, but it's actually the complexity is not what's on chain, it's what's off chain. And how can you get that snapshot and be able to get it reliably? And maybe the way I was just answering the prior prompt is that when you start having the underlying assets on chain for the stablecoin, well, then it's very simple. It's like very easy to do that match and be able to see it completely directly in real time at all times. And so I don't think it's going to take 10 years to get there. I think the tokenized treasury market is already starting to grow, and it could be quite significant in a relatively short period of time. I could imagine in something like 3 or 4 years a situation where maybe the percentage of your reserves for a stablecoin that are not held in on-chain format could be quite low. But ultimately, you have to have it be 100% in order to be able to really have it be 100% matched, same to same. But I certainly think we're going to get there.
All right. Next one here is for large volume financial market settlements. What resilience features should stablecoins have beyond those required in the Genius Act? This one's for anybody. Maybe the Genius Act is perfect. All right, I guess no one's got anything. Genius Act is perfect. There you go. Thank you, Senator Haggerty and team. All right, Chad, here's the question you were expecting, of course. With the problems last week, what went wrong with the minting process? Did the blockchain work as expected? And I guess for context, for those that don't know, I think last week PayPal, for 24 minutes or thereabouts, printed 300 trillion US dollars and then unprinted them.
We printed it, actually. We don't cast aspersions here. The mistake was entirely ours. Certainly, we didn't operate at the standards that we expect of ourselves. There's an interesting situation where you try to determine where does it make sense to be fully automated and where does it make sense to have manual interventions in order to be able to create additional levels of security. And in this case, our operational manual processes were put into place for a deliberate reason in terms of being able to create very secure cold minting processes. But it's something that we rarely use. And so that led to an error in how much was minted. We knew within a minute or two it all was contained on our system. It never left our system, which, by the way, should never diminish how seriously we take this. But it did, of course, lead to there being an overmint of a fantastically large number. And of course, the unwind of it. I think that, the importance of this, to me, is it underscores the value of the blockchain. It actually shows the transparency that you can immediately have into what's going on. And so in this case, an operational error that was entirely internal to our systems is now immediately visible to everybody. So I'm sitting here, of course, talking about this and making it really clear about what we could do better. But that's important because that means you can have this level of transparency throughout the entire financial system over time. That's a really positive thing. It's, of course, painful to go through, but I think you could just imagine having a world where you would be able to see exactly what's happening in real time and being able to have that level of transparency to understand how firms are functioning. And that can create confidence in the financial system in a way that the opacity that exists today has really limited. And that's why you get accelerator effects, and that's why you get run on banks, is because you don't know what you don't know. And so you're never going to have a perfect world where everything is completely transparent, but the more transparency you have, I think the better the financial system will be over time.
All right, I think we have time for maybe one more question in here. And of course, this is a nice phone one for us to wrap it up. If stablecoin issuers can theoretically have Fed payment accounts themselves, what need is there for banks in the workflow?
Well, there is a big value in intermediation, right? And if you don't have bank deposits, then the bakery perhaps cannot get a loan. And there's a massive value in that. And I think like anyone who's rejecting that value is not really understanding how the economy works. No? So of course, there would be a lot of value for banks. No? And perhaps this might be like a sort of Marxist view, no? But if stablecoins eventually bring transactional value to cost to zero, and the margins get compressed in transactional business, perhaps the implication would be that financial technology will be all about balance sheet in the end, right? So perhaps the question will be the opposite, no? And banks will be even more important.
I mean, I may just leave it at that. I don't know that. I think the point that you made, Fernando, that's dead on is I don't know how much people understand about the business, and not just the role that we play as a safekeeper of deposits, but as a provider of multiple payment services. As a lender, the role that we play in maturity transformation, which is important from an economic perspective, to your point. And I just think at the end of the day, all complex ecosystems require integrators. Okay, they just do, and they're, for the average individual, potentially short of healthcare, is no more complex, opaque, harder to navigate ecosystem than managing your personal finances. And the byproduct of that is, with the exception of people who live day to day, there will be values to bundling and to the build out of, there will be value to bundling and to the build out of services around the actual currency itself. Because if that wasn't the case, then, you know, for the last 50 or 100 years, we would have just been carrying stacks of cash around in wheelbarrows, right?
And maybe I'll add my 2 cents with 2 hats on. First, my Circle hat, then as a former regulator. So wearing my Circle hat, I mean, we put billions back into the banking system. It's really important to us that we're able to put money back into the banking system. So it is, in fact, continuing to do credit, you know, generation, credit intermediation. And I think, you know, we are very supportive of that. The last thing we want to do is have a situation where the banking system is disintermediated, right? Stablecoins are meant to be a payment mechanism, meant to be a version of cash. Wearing my former regulator hat, there are, however, certain instances, and I witnessed those as CFTC chairman during the COVID crisis, where our clearinghouses in the United States, the large, important financial market utilities, that didn't necessarily have a Title VIII designation and therefore didn't have Fed accounts, found themselves awash with cash, tons of cash with variation in initial margin, with no place to put it. Because the banks, to argue your point out there is the supplemental leverage ratio disincentivized banks to hold cash. And therefore, we had a scenario where the clearinghouses had all this cash on hand. Banks didn't want to take the cash, and we were in a major conundrum. So I would say there are instances where having a deposit-only account, not discount window access, not any kind of, you know, borrowing facilities, but just a safe place to put cash in certain circumstances would probably provide a stability backstop for the stablecoin industry.
I also think, you know, one of the important benefits of Genius in having payment stablecoins is that you can now separate fractional money, which I think is very important, from money that you're using in the payment system. And so having non-fractional money that is able to move through the payment system creates a capacity for there to be more resilience in financial crisis, where you can have accelerator effects or you can have run on banks. And when they were conjoined together, which they really had to be because of just the limitations from a technological standpoint, you know, you had whole parts of the payment system that were locking up when certain banks were having problems. And actually having some capacity to have those not be totally intertwined can be very effective in times where I think there are systemic risks that really become endemic in the system. And certainly part of that could be having use of a Fed master account. And it doesn't even have to be necessarily being able to go into debit at the Fed. It's simply being able to have funds that you're able to put at the Fed. And so in that way, you can not necessarily disintermediate the banking system, but you can create a mechanism for intermediation to continue through the payment system, even when there are times of stress.
All right, actually, we do have a few more minutes. I misread the clock. So a couple more for y'all guys. Any thoughts from this group on how the issue of revocability might be addressed in the stablecoin ecosystem?
That's probably for me. Yeah, so it's very important that transactions on blockchains are irrevocable. And as I said before, one of the things that the Basel Committee and others have said is an issue with certain blockchains is the fact that you have the possibility of having 51% attacks, and you have probabilistic settlement as opposed to final deterministic settlement. So no question that anytime something is on a blockchain, we really do need settlement finality. That's a separate issue than the one which is in a world of consumer payments where chargebacks have become an important part of the way that our consumer payment system works. Is there the ability to create some kind of opt-in as an application layer on a blockchain to facilitate chargebacks, right? To bring some of those great things that we have in the scaled financial system of today into the Web3 world. So that's the way I think it's an entire, if there is a need for something like that, it would be done through an application layer that everyone would opt into voluntarily, and at the same time preserving the irrevocable nature of the underlying blockchain transaction.
All right, going down the list here. Go for it.
I think there's a really interesting question on this one because given your point, like there are some use cases that are not amenable to being switched, right? I think one of the things that drives me nuts is whenever we try to compare the cost of accepting a stable coin to the cost of accepting a credit card payment, because if the decision on what sort of payment to accept was entirely in the hands of the merchant, right, they wouldn't be accepting credit cards today. The reason they accept credit cards is because people want to pay with them. And people want to pay with them because they want float or credit or rewards or the consumer protection associated with the ability to charge back a payment that you didn't make, right? So those are features of the product. We've spent too much time on and those features require economics to be able to provide them, right? It's simple utility. And the economics around the payment, then are attached to the provision of those sorts of features. And my own personal view on this one is we could spend a lot of time to replicate the feature functionality of all the different legacy payment methods and get nowhere, because what would happen is the cost to accept a stablecoin would have to go up in order to support all of these sorts of benefits. And in turn, you wouldn't see any sort of value shift. Whereas we have payments that move today in places where revocability isn't a requirement, right? It's not a valuable feature. And just mining those markets has got to be a huge TAM for people who are out there. So trying to get every rail to do everything doesn't seem to me to be the right long-term solution. Given that the rail that exists, the tech that exists today, there's a massive capacity overhang to do things where some of the things it can't do aren't a big problem.
All right, going next on the list here. Are we more likely to see existing payment rails like SWIFT move to leverage stablecoins, or see new rails for banks to adopt?
Man, I feel like that one's mine. I'm fond of, I think it's one of the A16Z folks, but the saying that the sort of battle for any market comes down to whether the incumbents get the innovation faster than the disruptors get distribution, right? And that's what you're going to see with all of the legacy payment utilities here, is the legacy payment utilities have to find a way to rewire around new technologies, new protocols, faster than the insurgents find financial institutions that are interested in riding on the rails. And I don't know that I would handicap that, but things that move large volumes have to be built to avoid hard right turns. And it means inherently they have to be slower, right? In this particular case, like our stance as a company has been to keep our options open. I tend to think that the insurgents may get the escape velocity faster than a lot of the incumbents are able to adopt the innovations in this particular market. But that's by no means settled.
All right, another one for Tim. What's the net impact of stablecoin adoption on credit creation? Do stablecoins drain capital from banks, institutions that primarily extend credit?
They wouldn't drain capital, they would drain deposits, and deposits are the more relevant factor here because we hold $1 in capital for every $10 in loans that we make, right? And therefore we need the deposits to be able to support the level of lending. That comes down to the rules that need to be written around anti-circumvention on the Genius Act, okay? It's clear to me that the intention behind the law was to prevent stablecoins from earning interest. It's not clear to me based on the behavior in the market that everybody intends to abide by those rules. And if stablecoins are allowed to pay interest, they pose a threat that is equivalent to, but potentially far greater than money market mutual funds did when they were introduced many, many years ago. And that would have a direct impact on the ability, on credit formation. I think there are some clever strategies there. So to the point that Heath made earlier, circle round trips deposits back into the banking system, that's quite useful in terms of supporting the ability to form credit. But if my read is right and the intention of the law was to prohibit people from paying interest, we should just get about prohibiting people from paying interest, whether they call it rewards or anything else, right?
All right, speaking of yield-bearing stablecoins, Heath, this one's for you, but others feel free to jump in. Why should or shouldn't we have regulated yield-bearing stablecoins in the United States?
Well, the answer is we do. They're called tokenized money market funds. And so that's the Circle position, is that a stable coin is the effect of the equivalent of cash. We think the Genius Act got it right, backed one for one. Anytime you're paying out and it's paying out interest, that obviously introduces more risk. But that said, we do think there's a need, obviously, for interest-bearing instruments, interest-bearing digital collateral. And so we've created, it's not available in the United States, but something called USYC, which does precisely that. But Circle's always taken the position that it's a security, it's a tokenized money market fund. And so I think those distinctions make a great deal of sense, and they're consistent with current law, including the Genius Act.
All right, I think we've actually made it through all of the questions. And I think we're probably coming in on time as well. So I think we landed the plane successfully, gentlemen. Thank you all.
Thanks to Kyle and all the panelists. So yes, you brought us in right on time and actually just a minute early for lunch. And I know we It's very quiet now. We went from a very lively, engaged, and some might even say loud lunch, to this very quiet, moment, I have to say. So I see folks are still trickling in a little bit. But I'm going to introduce our third panel. I'm very excited to have us a group of folks that's going to talk about AI and payments. Our moderator will be Matt Marcus. He's a co-founder and CEO of Modern Treasury, a payment infrastructure company focused on the automation of payment movement. And with that, Matt, I turn it over to you. Take it away.
Thank you. We have the coveted after lunch spot, so everyone stick with us. I just want to thank the Fed for hosting us this week, Governor Waller, thank you. And yeah, also we've gotten to work with a lot of the Fed team over the years, and so we've always been very impressed with everyone we get to work with, and just sharing the mission around advancing money movement in the country has been really exciting for us to work on. So thank you all for supporting that with the infrastructure you provide. I'm the co-founder and CEO of Modern Treasury. We're a payments infrastructure company that works with fintechs, startups, public companies to help them automate money movement. And so we work with companies that provide critical infrastructure to the economy across all different sectors: real estate, healthcare, education, payroll, so forth. So I'm excited to get us together to talk about AI and payments. And so we have a great panel here today. I'm going to let everyone introduce themselves in a second, but we'll try to cover a few different areas because what does AI and payments mean to you is something we'll cover different areas. We'll talk about agentic commerce a bit. That's a big theme of the day, so we want to make sure to get in there. We'll talk about fraud, which is always top of mind, especially with AI, so want to make sure we talk about how companies are thinking about that, how you can think about that. AI also impacts our internal processes. So how do we fight fraud? How do we build software? How do we advance payments innovation? And so assuming we have time, we'll get there as well. So that way we can think about how are we pushing the ball forward on innovation in the country. So with that, we'll kick things over for intros from the panel. We can just go in order here.
Great.
The red light means on.
Okay. Hi, my name is Kathy Wood. I am founder and chief investment officer of ARK Invest. We manage roughly $40 billion in equity assets focused exclusively on technologically enabled disruptive innovation. So the 5 major platforms are robotics, energy storage, AI, blockchain technology, and multi-omic sequencing. And our focus today especially is the convergence among those technologies. And I know that's one reason we're here. So very happy to be here. And I must say, I want to give a shout out, first of all, to Governor Waller and to Sunaina. About a year ago, I'm going to say, I found out, she approached me, I think, that you had a director of research on innovation, and I thought, wow, now we're talking. I hadn't associated the Fed with innovation, but I see how much you all are doing. You all are doing now, and she has been a force, to be sure, working with you, Governor Waller.
I love that intro. I agree. She has been a force. I'm Alicia Haas. I'm the Chief Financial Officer of Coinbase. Coinbase is one of the first and definitely the largest in the US crypto infrastructure companies, and a company that offers the ability to buy, store, transact in over 300 crypto assets on our platform, and then increasingly building on-chain. We have co-founded USDC, which is the second largest global regulated stablecoin with Circle, and are the largest distributor of stablecoins in the US market and globally, including USDC, PYUSD, and others. And importantly, are continuing to build tools for developers for them to build their own crypto solutions, their own payment solutions, and excited to be here for this conversation.
Awesome. I'm Emily Sands. I'm the head of data and AI at Stripe. Thank you so much for having us today. Stripe builds programmable financial infrastructure. So we support millions of businesses around the globe in accepting payments, moving money, and growing efficiently. Those millions of businesses include many SMBs, startups, including most of the AI startups, and also very large enterprises, including about half of the Fortune 100.
Hi, everyone. Thanks for having me. My name is Rich Widman. I run Google Cloud's global crypto strategy. Our team is really responsible for doing basically three simple things, not to understate it. The first is our main charge is to think about how large enterprises like Google incorporate some of these new technologies, not just in terms of our products, but also into our own kind of financial infrastructure, our own financial or enterprise DNA. The second thing that we're responsible for is we recently launched a layer 1 blockchain called the Universal Ledger, which is built for institutional payments, which has dominated much of the discussion today. And then lastly, we're also responsible for working on large open standards related to agentic payments, most recently the Agentic Payments Protocol, or AP2, which we partnered with Coinbase and about 100 others on in terms of thinking about what agentic commerce will look like, what forms of payment will agents use, and how do we complete that trust chain so that users and merchants can transact with AI confidently.
Great. Well, Emily, we'll start with you. Agentic commerce, we've heard about that a bit. What is it?
So, we're all experiencing how AI is shifting, especially over the last year or so, from just knowing, giving you the answer, to doing, executing on your behalf. And that shift from knowing to doing is quite profound, and one of the first industries that it's transforming is commerce, how commerce gets done. Agentic commerce is actually a spectrum, but I think of it as an agent facilitating a transaction between a buyer, whether a consumer or a business, and a seller. And if you think about a very simple but powerful consumer experience like instant checkout in ChatGPT, you can go today and look for a Halloween costume and get recommended costumes from millions of merchants. Maybe they're not all selling costumes, but certainly millions of merchants selling on Etsy, and you can buy direct in one click. And that feels slightly more deterministic than maybe the pie-in-the-sky version of agentic. But along the spectrum, you see things like Perplexity Travel Search and Booking Agent, where I can say I want to go to Paris, these are my dates, here's my budget, and it finds the flights and finds the hotel and gets the reservations for me on my behalf in a cohesive package. And so, Stripe has worked with businesses for over a decade, helping them sell wherever customers are. And early days for us, that was helping you sell online and in apps. We also have an in-person payments product with Terminal. And then it was helping businesses sell through platforms and marketplaces. And today, the new wave is agentic. And so we're really working arm in arm with the merchants that run on Stripe to help understand what is agentic commerce going to demand from economic infrastructure. I'd say there's two core needs that are sort of bubbling up to the top. One is businesses need to have a way to crisply articulate what they sell, their products, their prices, their inventory, their checkout experience to agents. And just like there's not one model provider to rule them all or one model to rule them all, right? We're all switching across providers and switching across models. We also don't believe that there's going to be one agent commerce solution to rule them all. And so we recently announced the Agentic Commerce Protocol, which is a shared standard, a shared language really, that allows merchants to communicate cleanly with agents around what they sell, how they price, and how their products should be shown. We co-developed it with OpenAI. Millions of merchants have already adopted it. And we're really excited to see the traction because a core challenge for businesses of all sizes, but especially small businesses, is making sure that they can efficiently expose who they are and what they sell to these agent facilitators. The second issue popping up, the second need, which won't surprise anyone in this room, is just fraud and growing risk vectors in the context of agentic commerce. And these are really multi-party risks, right? So as the consumer, I want to make sure my payments credentials are safe. I don't want the agent to see them or use them without my permission, nor do I want the merchant to see them or use them unless there's need. As the agent, I actually don't want to be directly in the flow of funds. I don't want to be the merchant of record. I don't want to take on the risk for the transaction. I just want to facilitate the transaction between the consumer and the merchant. And then as the merchant, well, gone are the days when I can just block all bots, right? Those heuristics aren't going to work because they're going to throttle growth. I need to be able to distinguish which are the legitimate transactions from legitimate customers passed through legitimate agents versus which are malicious. So, we recently released our shared payment token, which is a new payments infrastructure that allows the agent to tokenize the payments credentials of the consumer and pass them over safely to the merchant. And as those tokens are passed over, they include fraud scores. The same fraud scores from our Radar product, which has been around for over a decade, to help the merchant understand the validity and credibility of that transaction. So, again, early days, I think as we move down the spectrum of I'm just buying a Halloween costume in ChatGPT to I'm really unleashing agents to go do, most of my day-to-day commerce for me, we'll continue to evolve the protocol, we'll continue to evolve the underlying infrastructure like the shared payment token. But however it evolves, it needs to be an open ecosystem because, again, many merchants need to be able to sell through many agents, and it needs to work safely for the consumers and the agents and the merchants alike.
And I'm sure the protocol supports different payment methods, but cards is what it's starting with right now for the most part?
Yeah, lots of talk of stables today, but many people still use credit cards, believe it or not. Okay. Yeah, so we support over 125 payment methods. And I'll also note, I said open as if that's only open across agents or open across merchants, but it's also open across payment providers. So we are often passing that shared payment token over to the merchant to use on another PSP. That they're operating on. And so we really want to make it easy for global customers to engage in agentic commerce. We support over 125 payment methods today, but we also support the shared payment token used on other PSPs.
I think that's one of the, just to chime in here, one of the focuses that we had when we worked on our standard was something similar to this, which is, we should let the consumers and the app builders and the merchants kind of pick the path of least resistance or the path of optimal outcome for them. And it's one of the reasons why when we were talking about this, I think a lot of the discussion around any agent payment protocol was really, what does payments look like today? And how do we make payments today work with agents today? I think our point of view was what will payments look like tomorrow? And when we think about agents and their capabilities in the commercial realm, what are some optimal forms of payment today that might be small, but we think have an opportunity to maybe have even a head start in this world. And I think that's one of the reasons why AP2 works with X402, which is the open standard that's what's actually been around for quite some time. I don't want to bore people with this, but it's been around since the beginning of the internet, but it's basically an HTTP request that's called payment required. And so in many ways, we actually see stablecoins as an optimal form of payment for agents because they do facilitate all the things we've been talking about today, which I won't rehash. But I do think it is important as we think about what merchants want and what consumers want that we leave the option open to them as opposed to kind of dictating or even just walking them down the path of inertia that already exists in the space. But I do think there's a lot of unhobbling that still has to happen there. It's still early days for sure.
I mean, the internet taught businesses that they need to meet customers where they are, which was online. I think agents are teaching businesses that they need to meet intelligence where it is, which sometimes is in MCP servers and has a bunch of different, right? And payment methods and payment infrastructure will need to evolve to support that.
So Alicia, going towards stablecoins a little bit, what's been happening there? Like, what are some of the recent developments that you're looking at, and how does that play into this space around agentic commerce?
I cannot agree more that we need to meet customers where they are. And what customers have shown us is that stablecoins are being rapidly adopted. Stablecoins have crossed $300 billion of market cap. And the two that have been adopted, importantly, are open infrastructure stablecoins. They are interoperable. They have deep liquidity. They were built on permissionless networks. And I think that's a really important data point around what we're seeing customers adopt. So they were born from necessity to enable traders and market participants of crypto trading have a US dollar to settle into in a 24/7 market. Regular fiat dollars did not offer that because banking hours were not matching the crypto markets. And so as market participants grew accustomed to stablecoins, it's now opened up this door to payments. And we have three catalysts that have occurred. One is regulatory clarity. And with the Genius Act, and for many of you who have been involved in getting that legislation passed into place, I'm really grateful because it has provided now many market participants the confidence to come and now build in this space. We are seeing growth and adoption of banks, PSPs, corporates, merchants. Everybody's now saying, okay, this is interesting. Let me talk about the benefits of stablecoins and what payment flows those could be uniquely suited for in my business. It's not going to fix everybody's problems. There's going to be a lot of credit cards. I fully agree. Just like we text, we email, we send mail. Like, we have lots of ways we communicate with data. We're going to have lots of ways we communicate with value, and we send value to one another. So, but what we have today is regulatory clarity. We've also seen blockchain scaling. And so we now, for example, with Base, our layer 2 solution, we do $1 trillion of monthly volume on Base. We are already at the thousands of transactions per second. This is real. Theoretically, it has no upper limit on its scaling. I think it's important to think about companies that are focused on scaling only may be missing security and or decentralization. So this is an important three-legged stool. I don't think it passes notice that AWS was down yesterday and it impacted a lot of access. Ethereum was not down yesterday. Base was not down yesterday. So decentralized protocols show a lot of resilience, and that's something to think about when we're talking about creating payment networks. And there's already things such as optional privacy on Base. The tooling continues to get better. It's much like AI. Like, every month, every year, we just see big leaps forward in terms of these technical advancements. So where this dovetails then with agentic commerce, where we're also seeing these big leaps forward day by day, I think that stablecoins, much like Emily and much like Rich said, are uniquely suited to agents. Agents can't open a traditional bank account. Like, that doesn't get through a bank onboarding process. They can open a wallet. They can be programmed. These are programmable dollars where they can set limits. They can white label the addresses they want to pay with. And as you think about the growing types of machine-to-machine transactions that we're going to have, we think it will grow up alongside of human-to-machine transactions or human-to-human transactions. But it's going to be a growth of the number of transactions that we see. And so stablecoins, we think, are uniquely suited to micropayments. Like, it's really hard to do a 2-cent payment through any other payment vehicle that we have. It's cost prohibitive, quite candidly. It's not cost prohibitive in a stablecoin. It's uniquely suited then to, hey, go do some code for me. Oh, you need to go buy compute? Great, go buy some more compute power from Google Cloud. Like, program that in. Moving with speed. So I think we think there's a lot of very natural problems that will get solved immediately with stablecoins, and we're just at the beginning. And then, as our colleagues have shared, each of us, we are all involved right now in building critical infrastructure. We've talked about X402, which is enabling any developer to seamlessly embed payments now. We are building these as open standards. We are sharing these out to the world for others to build, because interoperability, adoption, we think will grow to create the most consumer and business benefit. It will lower the cost and create just more inclusion into the financial systems. There will be use cases that will go through different paths, but we believe that this will drive a lot of global adoption of these technologies.
Yeah. Rich, this morning we heard panelists mention the use case of agents scraping the internet and reading content and making these microtransactions. How do you think about that relative to DP2, X402? Is this in that agentic commerce bucket? How do the different technologies support those types of microtransactions?
Yeah, so this is, I don't want to get too deep in the weeds on the technical side, but if you're a builder in the audience, right, and you're used to making API calls, and a lot of API calls honestly could be done by an agent on behalf of the user. And so whether it's the sort of almost like the pay per crawl kind of example that's been used, there's a whole host of others, right? Like, we think about it when in the context of even just think about bots interacting with websites or anyone interacting with the website. Really, it's kind of funky to payment gate it for a bot right now, but with X402 or some of these agent payment protocols, you actually could have a bot hit a website, it get a 402 request for payment, and then a micropayment could be made to allow that agentic intelligence to basically have some limited access to the site. So it's, instead of it always being, it's got to be a proof of a human, or I'm blocking it entirely because I'm worried about IP or other things, there's actually now another modality for commerce that can take place, and then in that context, you would think like, well, what is the value transfer that should be paid by an agent for looking at a single website page? Maybe it's a couple cents, I don't know. And in that context, a traditional payment method really just wouldn't make sense. So I think when it comes to anything that involves an API call or hitting a web page, these things can be wrapped by an agent in some ways and then served either to other agents or users who want to interact, and having a common protocol or standard with which they can make a payment, I think is really important. Otherwise, you're just going to end up with really just a bunch of bad phone calls between agents or people and agents trying to get access to a website and saying, oh, well, I only accept this, and you haven't sent me the standard payload I'm required in order to authorize this payment. So I think it's really just about that script. The other thing that I see as an opportunity here is really thinking about how people browse, right, and like the buying experience generally. And so in many ways, I think the agent that we're used to interacting with of yesteryear is this little chat bot that like you go to the insurance site or you go to the Reebok or the Nike website, and those things are pretty much useless unless you really hate this merchant and you want to yell at them and like you're like, I just want to talk to somebody, you talk to the chat. But I do think there's an opportunity where websites can become far more optimized for browsing, where an agent actually helps me navigate the website in a way that looks and is far superior than what happens today, which is I type in something for like, I'm looking for shoes. It gives me a list of shoes that are for men, size 10.5, and I'm just going through very slowly. You could have a personalized experience that I think agents will unlock where it sort of is doing the hard browsing for you and surfacing up options that it thinks you'll want. So again, that's a situation where the agent is playing a role either by helping the user interface with a system, a website, or with an API of some kind, and then enabling new forms of commerce entirely, right? So the example of the browser looks exactly like what it is today. It's just an agent optimizes it. But doing API calls wrapped by an agent looks very different than what it looks like today. Usually developers are getting an API key. They got to go to the website, they put their credit card in, they get the API, they go back, put the API key in their coding dashboard, then they access it. And that's just a really clunky experience for things like data or any news feeds, pricing feeds, and things like that. So our view is that it will accelerate in many ways the proliferation of apps that contemplate, we'll call it agentic workflows or machine-to-machine interactions, but it will also optimize what I would consider to be like human-to-digital interactions or human-to-web interactions in a way that perhaps is probably a little bit more real for folks in this audience as opposed to the developer ecosystem.
So we heard a little bit about credit cards and stablecoins and then the base infrastructure. We're at the Fed, so I'm remiss not to mention FedNow and then the work there also, because we've been doing quite a bit of work on FedNow and the real-time payment schemes at Modern Treasury. And so I think even there too, when we think about agentic commerce, there's potential as those rails progress around the information that's encoded in the payment rails, the request for pay standard, potentially coming into some of these experiences, opening up other payment methods for the agents. So I think a central message here is there are different rails available for agentic commerce. It's not just any one of them, but there's high standards for what the rails need to support. For Kathy, I was hoping you could talk to us about why this all matters. So why is it good for society, the economy, if we have more commerce going through agents?
Yeah, and I'm learning a lot. Thank you. Oops, here we go. Learning a lot. So thank you to the panel. It increases my confidence that real economic growth, real GDP growth is going to accelerate. We have had a thesis for some time that productivity gains are going to drive real GDP growth much faster than anyone dares think. And I'll just give you a quick reason. So if you look at, and bear with me a moment, if you look at the period from 1500 to 1900, there really wasn't any innovation. And according to our chief futurist's analysis, working with academia and so forth, real GDP growth globally in that period was 0.6% per year. This was global. Then we had the Industrial Revolution, so three major innovation platforms back then: internal combustion engine, electricity, and telephone. Real GDP growth with that revolution, and that's the last technology revolution, true technology revolution, cutting across sectors. Real GDP growth increased from 0.6% to 3% for the last 125 years. We believe that with the breakthroughs like this one, and the productivity gains, because that's really what you're talking about, that are being unlocked here, that real GDP growth in the next 5 years will accelerate to 7% plus. And productivity gains, of course, now that's a global number I'm talking about as well. Productivity gains, knowledge worker productivity gains are the biggest reason. You know, we see productivity gains shifting up into the 4 to 5% range, if not higher. So this definitely increases our confidence. I love the open source movement and how, you know, I remember in earlier days in tech, and I've been around a long time, there were fist fights at this moment in the evolution of new technologies. We've learned not to do that, but learned about programmability, interoperability, open source. So again, it's increasing my confidence that the productivity gains that we are projecting coming out of the 5 platforms I discussed with blockchain technology and AI, 2 of the most important, it increases my confidence that these growth expectations will be realized.
The historical numbers are really interesting there too. You know, we see so much investment going into AI right now, but how does that compare to what we saw 100 years ago for other similar waves? Is this normal? Is this a lot? Is it worth it?
Yeah, we equate this to you know, the massive investment that took place around railroads and the early days of transportation. But what's different about this one is railroads had limits, right? Intelligence and imagination does not. And so we are looking at investment dollars. I know the big question is this another tech and telecom bubble? We do not believe that at all. First of all, back then, the seeds for what we are enjoying now had been planted during the 20 years that ended in the tech and telecom bubble. They were seeds. There was too much capital chasing too few opportunities too soon. The technology wasn't ready and the costs were way too high. We did not get the cloud until 06. Again, there were gleams in the eyes. I remember them. I was in the business at that time. We didn't get the first big breakthrough in AI until deep learning, 2012. Even bigger, thanks to Google, transformer architecture in 2017. And I can just give you a sense of how off-base investing was back then. If analysts had been using something that is central to our research, Wright's Law, they would never have invested in personalized medicine back then. It cost, to sequence the first whole human genome in 2003, $2.7 billion. We were not at a scalable point, $2.73 billion. Today we're down to $200. And we have, you know, the convergence now of life sciences and AI. So seeds back then, flourishing now. And I think, and this is somewhat contrarian, but it does, again, as I said, it does fit with Wright's Law. I think we might be underestimating the impacts of AI. Are there going to be bad investments? Yeah, capital chasing some ridiculous ideas. Always at this point in the cycle, there are. But given the productivity gains we see being unlocked, we see a lot of this investment as justified now.
That makes sense. So, Rich, how, if you're a leader, a public or private institution, company, how should you be thinking about this? Like, what's too early? What should you be investing in at this point?
Yeah, I mean, this is kind of like the ultimate question. I think if you're at a large institution, whether you're a regulated bank, whether you're in the tech space. So in many ways, I think this type of discussion like what's happening here is actually very critical to the next step. One, because it creates an opportunity for people to share ideas in an open way, much like the open standards we've been talking about for the last 30 minutes, right? Not necessarily written in code, but written in sort of communications and emails about, hey, we're interested in making the leap. How do we mutualize the risk with the right partners such that we're all marching forward on this path to innovation and trying to unlock the power of these technologies without necessarily owning all of the risk ourselves? And so I think, not just the public-private dialogue, but also private partnerships. That's been one of the key things for us. And I already mentioned what that meant to us in the AP2 standard, right? It would really not be a good idea, in my view, with all the change going on to basically launch a closed source point of view about how payments and agentic models should work. But even when it comes to some of the technologies we're talking about today, stablecoins in general, our journey has been one of partnership, just straight up. And the reason for that is we cannot do everything ourselves, right? Every institution has its strengths, it's the things it's very good at. It has areas where it needs to supplement where it's not its strongest. And so I think that's been the path here, is like people who are trying to kind of go it alone. I find that they struggle the most. Maybe it's a build-buy partner decision, but that's generally been our point of view, is there are things that we can do well and we'll be opinionated about. AI is one of those things. There are things where we know we have partners in our ecosystem where they're the subject matter experts, and doing a 1 + 1 = 3 situation is actually better than us just trying to do that ourselves. And those are our payment partners, it's the custodians at the crypto companies, it's the protocols themselves. We haven't talked about auditability and accountability when it comes to agentic commerce, but that is where blockchain protocols shine. Because right now, if you think about traditional payments and Rails, there isn't really a public auditable record where both agents of the user and of the merchant would actually be able to verify something happened. And so that's, we are trying to work through that layer cake, offer our own technology where we think we have a strength, and then pull in partners where that works. I think that's actually, probably we all agree with this on the panel, is that there's some things that we can do on our own, and then there's some things where we're a little bit better together.
And I would just encourage all of the companies to listen to their customers. What we're seeing now is that customers are really demanding the products and they are seeking the benefits. And so listen to your customers, what do they need, and then serve them in the best build-by-partner way that you believe that is best for your company.
Yeah. Talking to customers, always the
always.
Best of this.
Customer's
Yeah.
always right.
Yeah, customer's always right. Kathy, how do you think, for folks here from the public side, how should they be thinking about accelerating this innovation? What's important to support the ecosystem as it's in this moment?
Well, and I'm going to thank Coinbase for its leadership. I remember in the day when the SEC was suing Coinbase, we were sitting there saying, okay, what do we do about this? And your leadership really helped drive the clarity, the regulatory clarity that we are beginning to enjoy now. So anything in that score. I would say, in terms of risk mitigation out there, just from, we're looking at the prediction markets and thinking this could be a real place, again, for more clarity, and we're seeing some, but risk mitigation in terms of commerce, buying insurance for your air flight. I mean, it's a ridiculous cost now. If we bring, it's really bringing consumption and investment together. I think that's a convergence that we're seeing more and more. I heard probably 10 years ago, Jack Dorsey and Mark Benioff talking about this concept, and I'm hearing it more and more up here as well. So this idea that the consumer is involved in deciding how much a risk, covering a risk, insuring against a risk should cost. So I would also say this idea in terms of clarity, but also technology, the programmability, open standards, not putting roadblocks in the way there. I think that is going to be critical. Again, we're hearing this on the panel. And so, I think because our regulatory regime was so hostile, especially against blockchain technology, we're coming through a rubber band stretching And now it's going because we had a lot of time to think.
We did.
We had a lot of time to think, and you know, it might have been a blessing in disguise. We certainly didn't think so at the time. But I think a lot of very good things are happening because regulators, they understood finally that if we were going to block innovation, it was going to leave our shores. And for goodness sakes, this is the next generation internet. We started that movement. We should complete it, and we should encourage it, you know, into the rest of the world now that the cost of innovation is collapsing as much as it is.
Well, we're going to move on from agentic commerce to other good things that are happening in the world. So we'll get back. I can see from the questions we have agentic commerce questions in a bit. Emily, I was hoping you could talk about how AI is just impacting startup formation, the types of things and what people are working on, and what is that demand of the payments infrastructure these AI companies need?
Yeah, so we talked a lot about agentic. Agentic is a sliver of the AI companies and AI work and AI value being done. And one of the things that's fun about working at Stripe is we get kind of a front row seat to each successive wave of innovation. The current wave is AI. And we are a bit of the skeletal system for AI companies. So they use us, yes, for payments, but also for billing and for reaching global customers and for tax. And so, you know, all of the Forbes AI 50 companies that actually monetize on Stripe, and we get this kind of glimpse into what's happening with AI. You mentioned, Richard, the importance of symmetric information. So maybe I'll share like a few trends in the AI wave we're seeing, and happy to go from there. The first is just the rapid pace of monetization. Like, so many of these companies are private. And so it's a natural question. Is it a bubble? Is there revenue? Is the revenue real? Maybe only investors know, or the flashy number that someone puts in their press release. But I can tell you from looking at the AI 100, we call it, the 100 AI companies that are highest grossing on Stripe, the monetization is very real, and it's a pace unlike anything we've ever seen before. So to give you a sense, these AI companies, on average, get to 30 million ARR in just 18 months. If you want to benchmark that with like the 2018 cohort of equally promising top 100 SaaS companies, that's like 3-4 times as fast. And the earlier cohort, right, you get to 1 million ARR, you get to 1 million ARR in less than a year. Again, 4 times the pace of earlier SaaS. And part of that is that these companies are going global basically from day one. Like our AI 100, they finish their first year already selling into 55 markets and having the majority of their revenue come from outside their home market. And that might not surprise you if you're talking about a French startup that also sells into the US, but it is also true for US companies selling abroad, right? They're selling models and infrastructure and digital art and music and all sorts of borderless goods and services. And LLMs are really good at translation. So it's really easy to go global fast and to grow revenues very quickly. The second trend we're seeing is actually in the monetization model. So traditional SaaS had near zero marginal cost, so it made sense to sell sort of seat-based licenses. But with AI, the costs, the compute costs, the GPU costs are very real. And so that's breeding whole new monetization models. Usage-based billing, right? Charge per token, per workflow. Outcome-based billing. Intercom's a great example. They charge per support ticket resolved, which is a great way, actually, to tie pricing to the value that they're creating for businesses. And then most recently, like if you look at the companies, starting up over the last couple quarters, we're seeing a growing swath of what people call AI wrappers. And sometimes this is used in a derogatory way. I do not mean it in a derogatory way. These wrappers are brilliant, right? They are bringing an existing LLM that somebody else has and providing a wrapper with the local relationships and domain expertise and data to solve a problem in a vertical industry, right? So Nabla and Ascribe for healthcare, or Harvey for law, or Studio for architecture, right there. And we saw the same thing in SaaS. Started horizontal like Salesforce, went vertical like Toast. But the move in AI is happening much faster. And the monetization corollary of this is that these wrappers, because they're built on top of someone else's LLMs, have business models that are inherently tied to the cost of the underlying LLMs. So increasingly, we're seeing monetization models that track and price in real time to the changes in the underlying LLM costs. You can think of it as like a percentage on top. So that's the second trend. The third trend I would say is actually stablecoin. We talked a bunch about cards, but like if you go to Vercel today to use V0, you can buy in stablecoin. That wasn't true just a few months ago. You know, you can think of many of these AI companies. Shadeform is a great example. They're a GPU marketplace. They're selling internationally, right? So ACH isn't an option. And they have high dollar costs, like you're talking thousands of dollars in your transaction. So international cards are pretty unsavory. You get hit with a 4.5% fee, and you're likely to be declined at that size. So 20% of their revenue today comes from stablecoins. And we actually ran an experiment with them and learned that half of that 20% is fully incremental. As in 10% of that business would not be being done at all if stablecoins were not available because those buyers did not have access to another payment credential that was relevant. We talked a bit about fraud, but just to state the obvious, like transaction fraud, fraudulent disputes, that's what really matters if you're a retail company or traditional SaaS. If you're an AI company, you actually care a bunch about your compute being stolen. So you care about the full funnel of fraud. You need to know at the time of sign up, is it a bot? You need to know if the person engaging in your free trials are going through serial free trial abuse. You need to know if the person buying your large enterprise program and then burning down your credits is actually going to request a refund and leave you in the red. And so we're seeing a need for an increasing breadth of fraud-related signals well beyond sort of traditional fraudulent disputes. And then I'll just close with businesses are now being built in AI dev tools, like Vercel, like Replit. And it's not just AI businesses that are being built in AI dev tools. It's all sorts of businesses. And so payments infrastructure now needs to be deeply embedded in those tools because building a business isn't about building a functioning website with a back end and a front end. It's also about supporting transactions and enabling the money flow. And so we have a new product called Claimable Sandboxes, actually, which just lets you build your business in a box right within your AI dev tool. But I really think in the same way we talked about agentic commerce, consumers wanting to buy in whatever their AI tool of choice is, we're increasingly seeing the same trend for developers.
Can I just add one thing to this in terms of are we in a hype cycle? As we've sized it, by 2030, consumer-related, whether it's subscriptions, commerce-related, or advertising. Advertising is going to be a much bigger business. But those three will add up to, by 2030, $1 trillion in revenue opportunities. And many people will say, well, goodness, we're seeing spending $500 billion by Stargate. And well, that leaves out sort of the enterprise side. And I know we'll probably get to this in a moment, but the enterprise side. And we think between hardware and software, that is between a $8 to $9 trillion opportunity and maybe 15 trillion by 2030. For some of the reasons that you're stating, this is moving so quickly and it is having such a profound impact on businesses so much more quickly than we've ever seen before.
And what does it demand from financial infrastructure? It demands seamless and fast spin up of a business to integrate payments. It demands a much more robust and broader set of fraud controls. It demands access to new payment methods, including stablecoins, and it demands economic infrastructure that supports all these new monetization models so that the market can figure out efficiently sort of that intersection of supply and demand.
Right, and just to close this circle. So we're talking a lot about, it's B2B, it's business to consumer. I think so much of the benefits are coming in, productivity gains, and that doesn't show up on the top line. It can be turned into margins, increased wages, increased R&D, or lower prices. And so I think many people don't understand the other ways this can turn around other than directly to the top line.
Alicia, we heard Emily mention stablecoins as part of that flow a second ago, and I was hoping to just go back to that to talk about fraud as it relates to stablecoins. How should businesses think about that? Is it more or less than what they see with traditional payment rails?
It's the same problem with different solutions. So fraud exists in all payment types. Fraud's existed in credit cards, in checks, in wires, in cash. So there is fraud in stablecoins. However, stablecoins introduce a whole new set of tools to combat fraud. And I think it's important to think about those as opportunities. It's the first time you can see on-chain and permissionless networks the entire payment flow. You can use then AI and machine learning to look at payment activity and really have better informed fraud models that you can do proactive risk management on. You have the ability for whitelisting and blacklisting various addresses on a personal basis, at a company level, at an economy level. There's also a concept of freeze and seize, where if a stable coin ends up in a bad address through proper law enforcement and through proper judicial proceedings, you can freeze that asset and then remit the underlying dollars back to the fraudulent actor. The other thing with merchants is these are final. There's finality in these payments. There isn't a concept of chargebacks with stablecoins. And so from a merchant standpoint, this is a benefit to them. You can still then have different processes to then have reimbursement. But the key here is the tools only get better. As I mentioned earlier, this technology continues to evolve and build. And we are in the earliest days of looking what fraud prevention is, but we actually see less fraud, quite candidly, on our own systems coming from stablecoins versus from traditional fiat. The other benefit, just to Kathy's point that I wanted to add on, is in the spirit of where the value accrues, the efficiency of building with AI and with blockchain is just a brand new paradigm of efficient build. And just a quick anecdote, in looking at reconciliations and making sure that we are then ensuring that the transaction was legitimate, my own team can reconcile our crypto transactions, one person, half a day. It's basically all automated. It takes a team of 15, like 3 full days to reconcile our fiat transactions with all of the payment. So your back office costs, your settlement risk, you just take a lot of risk of settlement and risk of reconciliation out of the back office that accrues to the bottom line.
Does that end up, that ends up helping you just build more at the end of the day? So, I mean,
Correct.
Coinbase pushes out a lot of product.
It
Seems
does.
like this probably helps.
It's all about efficiency. Productivity gains, we can see by the end of the year, half of our code will be written by AI bots. And so that's the equivalent of almost doubling our R&D workforce.
Wow. Yeah. Kathy, I'm sure you want to touch on that. I mean, what are the implications of that? I mean, there's a lot more innovation being driven by AI-assisted engineering teams, a lot more R&D there. What was the result of that at the end of the day?
Yeah, sorry, Matt.
Go ahead.
It's the first place we saw how provocative the productivity gains were going to be. And that as we were doing our forecasts, we were having to raise them, as some of the early building blocks came through. So, and it got us to thinking more about that GDP growth number. Yeah. The productivity gains, again, can be turned around in so many ways to drive real GDP growth. So this panel is increasing my confidence in that forecast.
Yeah. Awesome. Well, I think we can move on to the Q&A. Just a reminder, folks can pop questions in here, and I'll take a look as we go. But there are 2 questions that are sort of similar on here, going back to agentic commerce. They're a form of what are real-world places where you can actually use an agent, so use ChatGPT today to make a payment. I'm curious if anyone on the panel has bought something with an agent. We could start there as an anecdote, but otherwise, where are places we can actually use these today? Go ahead.
So I really did buy my 6-year-old's Halloween costume on ChatGPT Instant Checkout. It hasn't arrived yet, but we still have like another week, so I feel good. No, it'll come. I have tried using Perplexity's travel search and booking agent. Actually, the Paris example, I was going to Paris for a Stripe tour in Paris, and then I was staying with my family, and it gave me great recommendations. I did not do the all-in one-click package, but I could have. With one click, had it buy my flights and buy my hotels.
Was there a reason you did it?
The reason I didn't is because my work had already booked my flights, so I actually didn't really need the full package. And then FIA, Bill Gates' daughter's startup is actually really cool. You can use it it's agentic shopping, but it also does like price compares. So it's sort of an always-on agent to figure out the best price for you. And then there's a bunch of niche-y ones. So one that I like is Barista Agent. If you have like specific tasting coffee beans, but you want to broaden your aperture, it sounds really niche, but I think it'll just give you a sense. Like there's not going to be one agent to rule them all. You go and you tell it like your preferences. I like kind of chocolatey beans, and then it goes out and it like scours the internet, but you have this conversational interface to engage around your bean preferences, and then it buys it, and they literally showed up at my door. So I think there's a lot of examples in the consumer space, in the B2B space as well, right? You can buy or sell from within Cursor. You can spin full businesses in V0 with a complete Stripe integration and claim your integration. So I think we are on the path, and I think it is still quite controlled, quite deterministic. Humans are still generally making the final call for the basket of things they are buying. And it'll be interesting to see kind of the pace of evolution.
Yeah, I think it looks it feels very similar to me when I was younger and buying things on the internet, and you're like, I don't know if this is actually gonna get here or not, but I hear this is really cool, and my friend said that they ordered it and it showed up. And I think it just will take time for consumers to build, again, we go back to this point of trust, but also these behavioral patterns around shopping with agents. What we see is very similar to what Emily said, right? We see a lot of what I would call paved roads already that kind of unhobble some of these issues that I think we've kind of spotted throughout the panel, where more work needs to be done. But there is a ton of interest. Like one of the demos that we did live, actually I think it was on stage at one of the Coinbase events, was somebody basically using their agent, their Gemini agent, kind of troubleshooting an issue in their house, which is, for any of the dads here, this is probably something that's near and dear to your heart, at least it is to mine. And there's a problem, and they're talking to their agent, and their agent says, hey, give me a second, I'm gonna go and look for some agents that deal with home improvement. A Lowe's agent comes into the picture, basically diagnoses the issue, and then it gives him a list of options that he can purchase for this new part. I think it was an appliance or something. And you can actually, the way that we do these demos is we unpack it so you can actually see the messages between the agents, and you kind of almost get to look inside the transactions themselves. In a consumer context, you're not going to see all of that. It's going to be abstracted away. But just in that demo and in that work stream, you can start to see merchants are realizing how much it will increase the velocity of consumer transactions. It's also going to change the patterns of consumer behaviors, right? Are they thinking about big box stores, or are they thinking about showing up here? And what I will say is every single merchant we talk to has an agentic commerce strategy, because they realize that people are no longer necessarily going to be walking into the stores, but maybe accessing their website via an agent of some kind. I think the other area where I see it that we've started to tinker internally, and shout out to some of the stable coins that we use like PYUSD, is actually playing around with treasury management. That's a really nice safe space because you're within the four walls of your institution, but you can have agents essentially move money from cost centers without really, again, exposing yourself to what I would say is all the real world counterparty risks that might be involved in a B2B transaction. And so those are the types of examples that I think are quite interesting, and probably we'll see more folks work on this. But I have to say, in the crypto space specifically, there are teams that have run at this 1,000 miles an hour, and I know there are teams that already today you can use their agent. And by the way, you bring your own agent if you want, to buy things on Amazon, like order snacks for the office. And that, I think, is, again, they're doing, I would say, all of that unhobbling work that it takes a lot of time, but we're going to start seeing people do that at an aggressively faster pace. I think the merchants will try and meet them in the middle as they see consumers prefer this path.
I'll just add on, in crypto, you can have an AI financial advisor that goes and buys crypto, buys the dip, manages your wealth portfolio in crypto, executes all your transactions, and we have a lot of employees internally who will test the bot against their own investments. And so they'll be on chain saying, did I buy the dip right? Did I invest in the right dollars? So it is moving very quickly, and I think that you will see use cases expand. And I agree with Emily, there's going to be multiple agents that serve multiple use cases, and I think that consumers really are going to lead this wave, and then you're going to see businesses follow up with products and services to augment and support them.
And I'll just add one thing there. That's very important because we think the consumer is going to move much faster than enterprises. You know, many people think this is about using tools in enterprises. No, it is not. It is about reimagining, reconfiguring your business. That is going to take time. You work with Palantir. We're only 70 people, and we're working with Palantir because I feel like this is so important and such a big opportunity. And, you know, we're doing this kind of away from the CTO. I mean, he's involved in it, but it has to be kind of orthogonal because the whole opportunity is orthogonal. So the MIT study that came out a month or so ago saying, hey, nobody's seeing productivity. This is going to be hard work to set up and really transform. It's going to take time, especially for the large enterprises.
It's actually, there's a question about what are the labor economics implications of these productivity gains? Are they offset? So it sounds like initially not as much, but over time, much more so.
What's very interesting, and we're experiencing it in our own firm, you know, I thought we wouldn't be hiring many people, but we're hiring more people now. Why? When I go to the finance team, for example, why? This is the easiest thing to automate and with AI. And the answer is we don't have time. So we're hiring very young people who are AI natives, forget digital natives, AI natives, coming in and empowering them to make this happen. So, but in terms of labor, I think there's a bigger question. The history of technology is it is a net job creator. Sure, there's displacement, but boy, talk about the best time this could happen. Baby boomers, I think, are retiring. I'm not sure if this is quite the right number, 1.3 million per year. We have immigrants, let's just say the immigrant population growing much less rapidly and maybe shrinking in here. And so, you know, you hear about truck drivers, you hear about transportation, you know, hair on fire, you know, that's such a big employer. They are, you know, these businesses are being hurt by a shortage of labor. So we think, you know, if you put into OpenAI or Grok, one of them, what jobs are going to be created in the next 5 years by AI? And you'll have to prompt a little further and say, we want you to use futurists, science fiction, sure, strategists, economists, technologists, all of that. You'll come out with a huge list of jobs. I highly recommend it.
Yeah. Another question we have here is, how is consumer privacy improved or at greater risk with agentic payments made with stablecoins? I don't know if anyone wants to take that, or Rich, it looks like you got something.
I mean, there's a couple things that I think there's a real opportunity to kind of improve the privacy surface area that consumers have vis-a-vis the merchants, right? So everyone kind of knows the story of they put some information into a website for a merchant or financial services provider, that individual or that entity has suffered a hack, and then all of a sudden you have this issue. And so you can really start to create ways, and this is where it dovetails really nicely with some of the innovations that are happening in the blockchain and generally the cryptography space. We're experimenting with the idea around basically delegating authority to an agent to reveal certain private information, perhaps to another agent. It could be a user on the other end, without actually having to reveal the credential, right? And this is what we call zero-knowledge proofs. Google Wallet now allows you to do this with your digital state ID today for age verification. And so the very simple way to put it is, traditionally we're very used to basically this idea of giving our information to a third party and then they just keep it forever. And the analogy that I like to go back to is it's kind of like you walk into the bar and instead of them just looking at the ID and then they give it back to you and you go get a drink, they hang on to it forever. Even when you leave the bar, they still have your ID. And that's crazy. But that's literally what millions of people do every day. And so zero-knowledge proofs kind of create that situation as it should work at the bar, which is they verify your age. In fact, it's even better. They don't even see the rest of the information on the ID. They would just know this person is authorized to be in this location, and then they have what they need from the merchant responsibility standpoint, and you as the consumer don't have to worry about the honeypot risk. So I think that, that chain of trust that we talked about at the beginning of the panel has an opportunity to make giant leaps, both as it relates to privacy, but also consumer control along the way. So that's one of the areas that we see opportunities, particularly as it relates to like identifying information or identity.
One question we just got, I think we can end on here too, is for Emily, just how do you protect the less tech-savvy users in these types of situations from people who are trying to drain their wallets, get information they shouldn't have?
Yeah, so I mean, in the case of agentic in particular, that sounds like. So this comes back to our shared payment token. So we are actually passing over the tokenized credentials needed to make the transaction for the product on the merchant that you have approved, and nothing beyond that, full stop. And before the shared payment token, we actually used an approach that's not dissimilar to financial infrastructure-wise, how we approached human agents. So like someone here has ordered from DoorDash or Instacart or something today, right? So if you like ordered from DoorDash, at the time you bought, you provided your credit card information. And then your DoorDash driver, who I'm gonna call a human agent, and then we'll talk about AI agent, was issued a single-use virtual card to spend on your behalf. So they didn't see your card credentials. They couldn't go buy whatever they wanted for themselves. They could buy from Starbucks near your location in the next hour for the amount you approved. And neither the human agent nor the Starbucks ever saw your card credentials. And actually our early versions of agentic commerce, before we had developed the shared payment token, used that same Stripe issuing product, single-use virtual cards, to accomplish the same thing. And so I think economic infrastructure has come a long way, but it hasn't come a long way overnight. The first version of agentic commerce was actually made possible by infrastructure that we had built for human agents, like these delivery drivers, so that they could operate on your behalf. And the only thing that's changing is you swap in the human agent for now an AI agent, but the protection mechanisms are actually quite similar.
I think the other thing that I'll just maybe say here about consumer safety is there's something in crypto that we talk about, which is building in public. And the benefits of building in public, right? This is something brought up and bringing it full circle to the DeFi panel, right? There are benefits to having these protocols be transparent and visible and auditable. And so in a lot of ways, I think the idea is that for the consumers who are savvy and they want to unpack that protocol, they can do so. But for the folks who are building applications where they have the touch point to the customer, there's an ability for them to be transparent to their end user if they need to, and also create that level of trust between the consumer, the application, and the underlying infrastructure or the guts. And so you have to do this balancing act of making the infrastructure invisible, right? People don't need to know how the roads work or how they were built in order to drive on them. That would be a painful process. But you also want to make sure that there's confidence in the safety of that infrastructure that they're passing on, say, for example, a bridge. And so in many ways, I think the idea we're trying to find is, with our service providers and partners, the right level of balance between giving users access to transparency, but also ensuring that they have the right controls and safeguards visible and apparent to them whenever they're using the application.
Awesome. Well, I think we're good to wrap up there time-wise. So thank you again. Thank you to the Fed.
Thank you.
Really nice to meet you.
Great to see you again. I cannot
our panel. Cool. So much is happening.
So we are going to head into our last break of the day. We'll be back. we are going to be talking about tokenized products. Leading us through this discussion will be Colleen Sullivan. Colleen is the co-head of ventures at Brevin Howard Digital, a global alternative investment management platform specializing in macro and digital assets. Thank you. Take it away.
Thank you. Good afternoon, everyone. I'm Colleen Sullivan. I co-head the venture team at Brevin Howard Digital. I'd like to thank Governor Waller, Sunaina, Ria, Alex, and the other folks at the Fed for hosting us. It's really been an incredible day. I'll start by saying this panel, I think, is the perfect example of saving the best for last. Each of these panelists really, before it was fashionable or safe to do so, recognized the benefits of blockchain technology, that they outweighed the regulatory and reputational risk of being early to the space. As moderators, we were asked to set the stage for the panel, so I'll do that very briefly. Recently, SEC Chair Paul Atkins announced Project Crypto, saying we're at the threshold of a new era in the history of markets, and that the SEC will seek to modernize the securities rules and regulations to enable America's financial markets to move on-chain. So during this panel, we're going to talk about how we get to this on-chain future state through tokenization. Now, before all assets are tokenized and move on-chain, which I do believe will happen over time, we're likely to see a gradual merger of traditional finance and crypto. Digital assets like stablecoins, tokenized commercial bank deposits, tokenized US Treasury money market funds, and all forms of crypto like Bitcoin, Ethereum, and Solana will trade and be used as good collateral in our traditional markets. At the same time, we'll see the reverse. Assets like public equities and commodities, which have historically traded only in traditional markets, are being tokenized and traded and used as good collateral in DeFi, as you heard during the first panel of the day. So it's very much a two-way street. Some of you may have watched the SEC's excellent panel on tokenization, and one of the interesting takeaways for me was that the panelists used similar but slightly different definitions of the word tokenization, and we had the same realization during our prep call. Tokenization means different things to different people. And I'll give one quick example. Let's take tokenization of public equities. Some tokenized public equities are synthetic instruments like IOUs or derivatives. They provide price exposure to the underlying, but they lack full legal ownership and governance rights. Other tokenized equities are issued natively on-chain, where the token itself is the security recorded on the blockchain. Our synthetic and natively issued tokenized shares of Tesla, fungible, both with each other and with traditional non-tokenized shares of Tesla stock. If they're not, what does that imply for liquidity and potential market fragmentation? Would a venue like the Chicago Board Options Exchange and its clearing firm, the Options Clearing Corporation, treat synthetic and natively issued tokenized public equities the same for purposes of writing covered calls and callers? These distinctions matter. We're now in a place where traditional finance brings scale, capital, regulation, and the world's deepest markets, and crypto brings transparency, programmability, composability, and efficiency. Together, I think they form a financial system that's stronger and more resilient than either would be alone. However, as this convergence happens, and as we now move into markets operating 24/7, 365, we need to ensure that the foundation of this new joint market infrastructure is stable, secure, and interoperable, and that it doesn't lead to fragmented liquidity, lack of fungibility, fragile collateral, and loss of privacy. So my hope today is to go a layer deeper in tokenization, and we certainly have the right panelists here to do that. So I'd like to begin by asking each of you to introduce yourselves, and if you could also share examples of what your firms have done in tokenization and the benefits that have accrued to your firms or your clients, as well as some of the challenges you see ahead. Jenny, you're in the hot seat first.
Great. Well, thanks, Colleen. I'm the CEO at Franklin Templeton, and we have built an infrastructure with a shareholder record-keeping system on-chain, a wallet infrastructure. It enables us to launch products on it. We, in 2020, launched a tokenized money market fund that's actually natively on-chain, and that allows us to do things like intraday yield. So if a hedge fund owns it for 4 hours, 22 minutes, and 36 seconds, you will actually get the yield for that amount of time. And I used to run our technology group, and we used to have record-keeping systems and none of them, because they're all batch process, allowed it. So it just creates so much flexibility. We also run validators on 30 nodes on, I think, 11 layer 1 platforms. And we have an asset management business within our asset management business that does model portfolios with tokenized crypto products. And we have a venture capital fund.
I'm Don Wilson. I'm the founder and CEO of DRW, which is a proprietary trading and markets innovation firm. We also founded Cumberland, which is our crypto trading arm, in 2014. So we were very early to the space. I think of crypto as kind of a warm-up for on-chain TradFi trading. And we're focused, we spend a lot of time thinking about that convergence and how we can leverage blockchain rails to make traditional finance more efficient. An example of that was this past weekend. We just did another set of on-chain U.S. Treasury repo transactions. And these were unique for a few different reasons. One, there was no intermediary risk on the Treasury, so it was DTCC that actually put them on top of a blockchain. All the transactions were atomic. So USDC and some other stablecoins were used as the cash legs. In this case, there was also rehypothecation. Because it was done on the Canton blockchain, privacy was preserved. So only the participants who needed to see the transactions saw the transactions. They weren't open to the whole world, which I think is very important. And in addition to DTCC, Circle, and some other stablecoin providers, DRW, Virtu, Citadel, B of A, and SocGen all participated in these. So, that's an example of stuff that's happening now that we're involved with, that we're super excited about.
Great. I'm Rob Goldstein, BlackRock's Chief Operating Officer. Interestingly enough, in 2014, my contribution on this topic was being the person in BlackRock saying, I don't know if I believe in this, but it seems big enough that we should create a small group of people who do nothing but obsess about this to figure out the right moment. And broadly, I would say the strategy that we've been employing at BlackRock is a strategy about bridging. You basically have the traditional capital markets, and then you have this alternative universe, this digital asset universe that has been evolving and obviously has tremendous momentum. And what we've been doing as a company is trying to lead how you bridge the two together. So for example, the IBIT ETF, which has approximately $90 billion of assets, would be a great example where there's a tremendous demand among traditional capital markets investors to have access to these exposures, but to have access to these exposures in the same old way that they could have access to IBM stock, and it shows up on that same brokerage account that they're accustomed to getting. Another example would be going the other direction, where we actually manage one of the largest tokenized money market funds, BIDL, where it provides the ability to have access to a BlackRock money market fund, but to have it as a token that lives in this alternative universe. So when you look at that strategy, we believe very strongly that a lot of what's happening is this, Colleen, you had said the gradual merging of these two worlds, and we've been trying as a strategy to be that bridge to help bring them together in every way possible.
Cara Kennedy, I'm co-head of Connexus. Connexus is JP Morgan's blockchain business unit. So we are in a unique position of sitting within, obviously, a significant bank like JP Morgan, but actively working to develop blockchain-based solutions for our clients. And we do that across assets, payments, and information, predominantly on networks that we operate today. And our focus is really on developing solutions, leveraging tokenization that will solve real-world problems for the bank's clients today, and help to develop those interoperability points between the legacy infrastructure that we clearly use for the vast majority of our business and the new opportunities that is afforded through the use of blockchain technology. So some examples of the products that we offer today, which leverage tokenization capabilities, would be our digital financing product, which is a product that our markets business operates, which enables the tokenization of collateral such as US Treasuries to be deployed in intraday repo transactions, which can be timed down to the minute, allowing repo sellers to much more precisely meet their liquidity requirements without having to have the kind of overnight exposures that would be required in the legacy infrastructure. So we enable tokenization of assets, traditional assets, onto our network. They can then be moved against our digital payment solutions. We operate 24/7, 365 blockchain-based payments infrastructure, enabling clients to leverage that. And then, as you may have seen this year, we also moved beyond into launching a proof of concept on deposit tokens, our JPMD product, which is initially launched on Base, and that really is looking to then meet what the need that we see next, which is to have a bank-grade digital cash product that can then be leveraged in the public blockchain ecosystem as well.
Thank you. Great. And the way that I've structured these questions, they're really open for everyone. So I don't plan on calling on any of you. So please just jump in. So the first one, when we think about tokenized money, so stablecoins backed by different reserve compositions, tokenized commercial bank deposits issued by banks with varying credit and regulatory profiles, maybe even eventually tokenized treasuries direct, how should we think about fungibility? And do you envision a future where we'll need to build new clearing mechanisms or special markets to price these assets?
I'm happy to jump in on that first. So, I think from our perspective, the products that you listed there, are very different products in and of themselves. And so I think we should recognize that there won't be fungibility between those different types, and maybe there shouldn't be fungibility between those different types. Tokenized deposits and stablecoins share a lot of characteristics, in terms of programmability and peer-to-peer transactions, but they also differ in very significant ways. A tokenized deposit has the quality of a bank deposit, and so largely, if structured correctly, should essentially be treated in the same way, and have the singleness of money that you have with any bank deposit that is held in a traditional form. And so we would see that those would be fungible ultimately, potentially across institutions, but with that stable value of a dollar that you see same as a bank deposit. But that is different than a stable coin. They're structured in a different way, and they are likely to be used in different use cases, perhaps different client segments that will leverage those products, and they will serve a purpose as well. So would expect to see those coexist. And then obviously when we get into more of the tokenized security products, whether that's treasuries or money market fund units or otherwise, again, those are meeting distinct needs, and just as in the traditional environment, should be considered different, distinct product types.
I'm just going to add a couple. We're just talking about a programming language, right? We have these conferences, and we're talking about it's a programming language, and it does some really cool things that make it better than some of the traditional rails. So that's great. But there's a lot of conversation about what should a stable coin, should they all be $1? Money market funds way back when had one break the buck, and it brought a reign of regulation down that have been really good things that control it, that it's pretty close to staying as $1. Well, why? If you think about what is risk-free, a risk-free investment is a US dollar, right? Everybody's kind of agreed that that's the best, safest investment you can be. anytime you add, just like in a chain, it's only as strong as its weakest link, you add other risk to it, it shouldn't be considered risk-free, and it will start to float away, of which the market will determine it in many ways, from the dollar. So what types of risk we have? Silicon Valley Bank was not a credit risk. It was a duration risk. So if suddenly you're holding a bunch of dollars but you've taken duration, you've just added a bunch of risk to that. The most recent fraud cases, Tricolor and First Trust or First Brand, or I can't remember whatever it's called, that's operational risk, right? They resold the same loans that somebody should have checked in and made sure that the loans were tagged in a system. Good news is with blockchain, it actually probably reduces operational risk. So, when we talk about the stable coins, first of all, not all stable coins are made the same as far as what the collateral is behind them. That will determine a lot of what their capability is, depending on whether people apply a discount because they think that in that there's additional risk to it. So.
And if I could, it feels a bit like Jeopardy here, I'm sorry. But if I could just echo, we couldn't agree more. This is just a technology. And I think where people often get confused, and one of the things that we get a lot of pitches at BlackRock from various ecosystem participants, what problem would fungibility actually solve? And is it a problem that's high on anyone's to-do list? And I think sometimes within this space, there's so much excitement that sometimes those steps are skipped. And I think importantly, going back to Jenny's comments about money market funds, there are differences between a bank deposit, a money market fund, cash, which is really a stable coin in its purest form is meant to be digital cash, and other types of investments, including short duration. So when you look at something like short duration treasuries, if you were in the traditional capital markets, it would never be fungible with cash at a price that's guaranteed. The price moves all the time. And I think that some of these concepts, there's a lot to learn, again, bridging the two universes.
So let's see, I will partially disagree. I think that
good. That makes a panel much more interesting.
I think that this statement that hey, this is just a programming language misses what happens when you take a so-called real-world asset and you put it on chain, and there are different ways of doing that. And if J.P. Morgan takes a J.P. Morgan deposit and puts it on chain, the character of that hasn't changed that much. It becomes a more useful instrument, but there's no incremental credit risk that's introduced into the system. Now, if let's say that there's a treasury security that's that matures, I don't know, the next day or something. It's a one-day treasury, and let's say that some, I don't know, intermediary tokenizes that and puts it on chain. Well, that has different credit characteristics than the original treasury. And so that goes beyond just the programming language. There's additional risk that's introduced into the system because of the activity this intermediary took. Now, that's not the only way of getting it on chain. I mean, somebody could deposit that treasury at the DTCC, and DTCC could put it on chain, and I would argue now no incremental intermediary risk has been introduced. And so, the devil's in the details on.
Okay, I'm going to respond. It's still a programming language. It just happens to have the application of the programming that introduces those additional intermediaries. And if you think about what this programming language does really well, it does three things really well. It has one source of truth. Guess what? A huge amount of I know BlackRock, Franklin Templeton, JP Morgan, our operational costs, the number of people we have that reconcile data between systems is huge. Oh, and then we got to do a transaction, go reconcile it with the counterparty. Another expense. This completely eliminates the reconciliation, right? That's just the application of this programming language. Number two, it has the ability to execute smart contracts. we do a foreign exchange contract with somebody in Indonesia, we'd probably go to JP Morgan and say, could you please be our counterparty because we don't know who they are. Guess what, atomic settlement, we don't need that anymore. Right, so it's just effective at how it executes on something that exists today, and third, it has a payment mechanism. And you can argue on the smart contracts how their value, I mean the stable coins, the value, but it has a payment mechanism. Again, those are the applications of the programming language that create opportunity.
Yes, they create tremendous opportunity. One of the questions that Colleen asked is, should there be some kind of a central mechanism to make sure that all these things are fungible? And my answer is no, absolutely not. These things are different. They have different characteristics, and it's important for the market to recognize that. And there are two different questions. One is, at what price do these things trade? And the other is, what is the appropriate haircut to apply to them if they are used as collateral? Those are two different questions. You could have a bunch of things that all are trading at $1 because the sun's shining and nothing's breaking, but a clearinghouse, and perhaps with the encouragement of the Fed and other regulators, could apply different haircuts to them to recognize the different types of risks inherent in these different items.
And Don, I think in what you just said, one very important component, and again, I believe there's a lot to learn from traditional capital markets here. A lot of what people are calling tokens are wrapped in such a way that they're really more like a structured product. And fundamentally, I think we know through many decades that not fully understanding structured products is very dangerous. And I think that to create pure tokenized assets that don't have that structural component to it is going to require a catalyst. It may not be the only way of doing it, but it certainly, in my opinion, would be a catalyst and catalytic towards having some centralized, trusted intermediary who could help be the tokenization agent to take your asset from, I hate the term real world, but from the real world to this alternative universe. I hate the term real world because who wants to take something of value from the real world and put it anywhere else? But at the same time, I think there will have to be utilities that people trust that assist with that, at least in the early days, because these structured products that are being created are ultimately going to become a challenge.
I think I completely agree with the points here about the absolute criticality of the structuring of these tokenized products. And in the applications that we have today, we have embedded the holding of the underlying position within a custodial framework, which clearly ensures that there is beneficial ownership of the underlying asset to whoever's holding the token at any given time. Now, obviously, that works within our applications for our clients. When we're looking at this, perhaps on a wider ecosystem basis, then it is important that we think through who that custodial entity is. And I was interested, Don, that you kind of identified that there is a clear risk difference of having a regulated clearing agency holding that underlying asset and being the tokenization agent versus, another providing that wrapper. And I think that is really important when we think about how the regulatory frameworks evolve, is ensuring that as far as possible, the token product needs to have the same legal rights and entitlements as the holder would have in the underlying traditional position. Obviously, if that's if it's a native issuance, if it's something that is that the issuer is putting on chain, that's much easier to achieve. But if there is an intermediary there, that needs to be in a framework which has the appropriate custodial responsibilities and the oversight to ensure that the holder of that token knows that they have all those legal entitlements that they would have in the underlying product. Otherwise, we definitely will be in a difficult position of having to navigate on a case-by-case basis what the kind of risk profile is, and what the the legal terms and entitlements are, which is simply not something that's going to achieve that institutional adoption or scale.
Yeah, so I'm going to ask a question that I don't know the answer to. So Rob, if somebody buys BUIDL on chain, do they have the same rights as somebody who goes directly to BlackRock and invests in your money market funds?
It's structured that there's basically equivalence, yes.
No, as I said, I didn't know the answer. Yeah, I mean.
But part of the reason why I say is because, and this is where I think it again goes back to like technology and what problems are being solved, in that, fundamentally, at some point, notwithstanding the success of the digital asset universe, people may want cash, or they may want cash at JP Morgan or something like that. And obviously, you need to go off-chain to do that. So you need to convert from a stable. The token is designed to be converted to stable coins. And then the stable coin, again, needs to be converted to dollars. So there's another hop. But in theory, it happens much faster than it would if you were buying a traditional money market fund.
So I'm just going to make one. Again, I say it's a programming language, but I love this programming language. I mean, it's very cool. It does some great things. So Franklin's money market fund is natively on chain. So what it can do, I mean, we literally calculate every second a yield, and we pay it every day in the account. So you actually see it. That's unlike our traditional money market fund, where it was too expensive to do it. You needed $500 to open an account. Our on-chain money market fund, you only need $20 to open an account. And honestly, you're going to be able to trade it 24/7, 365, right? So that is what this is going to bring. And the cost differential, because you don't have all that reconciliation and everything, is dramatic and is important. And so when I say that a hedge fund who can own it for 4 hours, 32 minutes, and 22 seconds gets paid, that's a really cool thing. The question is, to Rob's point, I'm not seeing a bunch of them jumping in and saying we need that, but maybe they do. And more importantly, what happens with technology is the first thing we all imagine is only to be more efficient at what you do today. This is going to enable some really interesting, cool, innovative, and a lot of stuff is happening there. So I don't want to dismiss those things because it will, and there needs to be an element of catch up, but it does some pretty amazing things. And just in our money market, I can see the difference of what this technology brings.
And Jenny, if I could just echo that, I think one thing that this panel may not have done the clearest job on, this is not even like the first inning in our opinion. Maybe it's the first inning. This hasn't started yet. So global equity market cap is $120 trillion, something like that. Yes. Like, if you really think about, this is still so early. So as we're talking about use cases, I would argue that many of the use cases with regard to tokenization today are either pilot-ish kind of projects, or they're production projects that in reality have been engineered to be in production, or they're very limited applications with certain like digital asset companies doing things with their treasury. There are very limited case studies today. This hasn't even started.
And yet Bitcoin has had more transactions in 2024, I think, than Visa and MasterCard combined. So I mean, it's massive.
Yeah.
First, I have the easiest job in the world because you guys just ask each other questions. So this is awesome. And I just get to sit and learn. So Rob, definitely we are early. Part of the reason I wanted to raise these questions, though, is it's also moving very fast. You know, we saw NASDAQ file to have tokenized public equities trade on the platform. They're working with DTC. They think this is going to be ready, Q3 of 26. We see the CFTC has an initiative for tokenized collateral and stablecoin being used as good collateral on DCOs, DCMs. And that's why I wanted to raise these questions. And then there is nuance within the products. Tokenized public equities, you can have derivatives effectively, or issued natively on chain. And I think it's really important that we think about what is good collateral? Like, what do we want coming into our traditional markets? And how do we haircut that? Like, how do we think about those things? And one thing I wondered, I mean, given that we're here at the Fed, you know, with the Federal Reserve having joint oversight of our primary clearing agencies, ICE, CME, Options Clearing Corporation, you know, is there a role for the Federal Reserve to play in helping sort out, like, what kind of collateral comes back into our traditional markets?
Yeah, so I think absolutely. I think that this is a great opportunity for the Fed to lead on this, you know, to be a thought leader. And, you know, when it comes to, you know, just focusing a little bit more on stablecoins, you know, I don't think that it's a question, it should necessarily be a question of you know, a binary question. It should be, what are the criteria for thinking about the haircuts? And I don't think the Fed should be the one determining the haircuts. The clearinghouses should, but the Fed can talk about the principles that should be used to determine the haircuts. And so, you know, I think that those should be, you know, what is the credit quality? And that's both the underlying assets and as well as any intermediary risk introduced in the wrapper. What is the liquidity profile of those underlying instruments, and you know, what is their convertibility or the ability to transform them into cash almost instantaneously? And then what is the transparency? And this is an opportunity for you know, stablecoin issuers and money market funds to compete. Eventually, I envision a world where all of the assets, whether it's a stablecoin issuer or a money market fund, that all of their underlying assets are on chain. And we shouldn't have to wait for the monthly audit to see where the stablecoin reserves are invested. We should be able to see in real time where those are. And that, you know, hopefully we see competition towards that transparency. And then, you know, you can look at it and you can say, okay, well, you know, this stablecoin issuer decided to put their reserves primarily at in bank deposits. Okay, that's probably less safe than a different stablecoin issuer that has it all in very short-dated treasuries. And you know, there can be a discussion about what the haircut implications are for that. They're probably all going to trade $1, but the haircut implications are going to be very different.
So, Don, I agree with that. I think we're quite some time away from that. I agree with that. I also think we need to take a step back. I think there's a tremendous role for the Fed to play. I think it has to start with education. So as a starting point, you know, some of us, I know Jenny's definitely in this camp, we spend a tremendous amount of time traveling the world and meeting with asset owners all over the world. And many of them are among the most sophisticated asset owners on the globe in the capital markets. Not only do they not understand a lot of what we're talking about, but to them, it has to actually solve a problem. So if you're going to start having a little bit of the portfolio over here on this sort of alternate universe, but everything else is over here at JP Morgan, that actually doesn't solve a problem, it creates a problem. So there has to be a value proposition, and I think there are still a fair number of people who need to be educated and just some fundamental frictions that need to be resolved to make it easy for asset owners to continue to see their whole portfolio. And I think a lot of times we have these discussions and it becomes very binary between like everything's on chain or everything's not. We're going to have to be building technologies and building an ecosystem that is thinking of a hybrid solution, because that's the realistic outcome for many decades.
Yeah, I think that's a really valid point around the readiness for adoption and what that really means, because I think, you know, we've talked about some of the transformational potential of this from an asset perspective, but also that that means moving away from, daily cycles for funding settlement, or, would mean differences in terms of how, data is consumed if you want that real-time visibility. And I completely agree with you that is something that from a service provider perspective, there's going to need to be the ability to move at the speed of the client in terms of, for those that want to make more significant changes to their operating models to allow them to really engage with these types of assets, great. But also there's going to be plenty who are only interested in the investment case. They want to access that asset and they don't want any additional complexity or pain, and there's going to be a need to take that away as well. So it's definitely going to take a bit of time to adapt, but if we don't find a way to do both of those things, it's going to be very difficult to kind of jump into that end state.
Yeah, I mean, to the, why would somebody do that? Why is it worth the trouble? I think that it's pretty clear that a lot of traditional markets are going to go to either 24/5 or 24/7. And as soon as that happens, guess what? You need to be able to move collateral 24/5 or 24/7. And so I think whether people want to or not, they're going to, find that this is an essential part of how they manage their assets. And I agree, there is a world where that kind of hybrid system is more complicated. And I think the goal is to make it the least more complicated that it needs to be.
Yeah, and I think importantly, just trading 24/7 is more complicated. So it is, what is the optimal way of creating an infrastructure to manage in that world?
Well, that leads me perfectly into the next question in terms of 24/7, 365 trading in the crypto markets. So far we've focused on crypto assets moving into our traditional markets, but I think we also need to spend some time on the reverse. So as traditional assets like public equities and commodities are tokenized and traded and used as collateral in DeFi, what are some of the issues we should be thinking about? So some of the things I think about: fragmentation of liquidity on-chain and off-chain. Are there challenges to using oracles to price tokenized assets accurately? Do we need some form of circuit breakers in DeFi? I'm not sure how we would do that, but it's a question. How do we ensure, and Don, I'll definitely start with you, but how do we ensure that centralized and decentralized exchanges don't shut down and not accept deposits during times of market stress? And should we rethink how auto-deleveraging systems work in DeFi? And the reason I'm going to start with Don is he published a great piece last week called "If DeFi is the Future of TradFi, What Did Friday Teach Us?" And that's referring to October 10th, where we saw about 19 billion in liquidations across the crypto markets. So I'm wondering, what are some solutions here? Don, this one I will pick on you to start, and then would love for everyone else to join.
Yeah, so, I was so perturbed by what happened and some of the failures that we saw in the market that I decided to send out my first ever thread on X. So I don't know, maybe it will all go downhill from here, but and so some of the points that I made, I highlighted some things that happened on October 10th that I think that a lot of people in traditional finance aren't aware of, that these things happen. And when you go to 24/7 trading, then you need to go to real-time collateral management, and it brings all sorts of challenges with it. And that the time that this kind of flash crash happened was a late Friday afternoon Central Time. Probably one of the most illiquid points of the day, and also a time when a lot of people's systems are kind of take a break. And so some of the things that we saw were oracles became unreliable. So an oracle is the mechanism that's used to record the price that you're using to measure whether somebody has sufficient collateral or not. obviously that's a really critical thing. And so, I think it highlighted the importance of having really robust oracles. I think that oracles should be properly regulated. The other thing that happened was, some of the crypto platforms actually provided liquidity for the liquidations themselves. And this is kind of one of these practices that I think is just a horrible practice where, an exchange has their own market maker on it. It just creates all sorts of conflicts of interest. Definitely not best practice, but especially then when that liquidity provider is actually the, kind of steps in to take the final bit of the liquidated order. And you can see it on chain on some of the platforms where, the first clip of liquidation was sold into the order book, the next clip was sold into the order book, and the final clip was internalized and then sold back into the market half an hour later for a big profit. And you couple that with the observation that some of the wallets were closed. In other words, people were unable to top up their wallets, presumably because there was so much activity. But you kind of ask the question of like, well, did that benefit the exchange or did that benefit the platform? Did they make more money in the liquidation because people weren't able to top up their collateral? And all of a sudden it just doesn't look good. I'm not at all suggesting that that's the case, but it just highlights the problems with these conflicts of interest. And so that is definitely not what we want to replicate. And that was kind of the point that I was making.
Look, the things that happened on that day are things that have happened in traditional finance in history. And it just takes time for the system. Binance's pricing system worked until it didn't work because they had one source of pricing, and it was, probably one that anybody who really looked at it would have said, that's probably not going to work in times of stress. I mean, these things happen, right? This stuff will all evolve as they get identified. In traditional asset management, everybody talks about private markets and the growth of private markets, and we need to democratize them. And blockchain is going to be the great way as we tokenize private markets. And I always say, this potential exists today, but you don't get liquidity unless you have market makers who exist there to create liquidity, which means you have to have an inventory, which means you have to have a system that's in place. All these things evolve. I think it will inevitably, we will go to 24/7. By the way, if you have a Schwab account, you can trade 24/7. And I think less than 4% of their trades actually happen after hours. So it can happen. This is definitely going to be a more efficient way to do it. It's going to be cheaper to do it. And you need to have the arbitrage between markets. I think Franklin stock is, New York Stock Exchange and the London Stock Exchange. Guess what? There's people who arbitrage pricing so that you ensure that it stays very narrow. And that infrastructure, the maturity of it, hasn't been built today yet. I mean, it's happening. And as it happens, I genuinely believe it ultimately replaces the current rails in the system. It takes a little time to do it. But we also shouldn't forget that there are a lot of big companies that are toll takers on the current system and are actually incented for this not to happen very quickly. And so that's going to slow it down too. But again, I think the capabilities and the evolution of the market, these kind of days that happen, wake people up to issues that you then go and fix.
But it's interesting because, and maybe this goes back to the point earlier, the question earlier about the role of the Fed. I think importantly, if you had this kind of issue in the public markets and it was about some arbitrage or some...
but you had
it leads to someone looking at it and actually knowing that tomorrow will be better than yesterday in terms of having supervision of infrastructure, certain standards, market quality, just a variety of things that I think for the capital markets to have widespread adoption here, we have a gap between where we are today and where it ultimately needs to be.
Yeah, the challenge is this infrastructure is going to make it a heck of a lot easier to move money across boundaries. and there's no global regulation around it, so you're still going to have this mismatch that honestly you have a little bit today, but a lot of people follow the Fed, so you end up in big developed markets having a little bit more standardization.
Right, but even something, Jenny, going back to your point about whatever exchange, importantly, if you think about the number of people who must do reviews of just the basic technology governance of the New York Stock Exchange, I don't know what the number is, but I'm assuming there's a lot of people who do a variety of like technical due diligence on them as part of their regulatory regime. There are certain basic things you could do if you want to transact here.
Agreed, but again, I mentioned the two frauds that we see. I mean, I used to do securitizations, and like I'm still trying to figure out how you sell the same loans. Like somebody's got to go in and change the system. Usually you tag them, so it happens even in traditional. Yes. I think it's harder. I think it will be harder to do with this technology going forward. I think that's the good news about this technology, but the development in the infrastructure doesn't quite exist.
I think I completely agree with you, Jenny, that this will evolve, right? And the events of Friday was really, that is something that is going to focus a lot of minds, both in the crypto space, but it is also going to be an education for any risk managers within any of the institutions that are looking to get into this. There'll be a lot of a lens on that. I think, Colleen, you asked the question about, thinking about that in the context of potentially, public equities and securities going into this environment. And I think that is really the key takeaway for me is to think about how careful we have to be about deploying, securities into these sorts of ecosystems where perhaps those risks are not fully understood or assessed at this point. And so ensuring we have the appropriate guardrails in place, ensuring that, if there are actors who are operating, whether that's, kind of activity that would otherwise be regulated in the traditional world as broker-dealer activity or exchange activity, that there is, that they are required to meet the same standards and regulations as exists in the traditional space, because it's, the capital markets and protecting, investors and confidence is paramount. And we know enough from the experiences of the traditional world that we don't need to make those mistakes in terms of the experimenting in this space. We need to make sure we go in with the right approach from the start.
So I just saw the unfortunate news that we're down to like 13 minutes. I was worried we didn't, that we had not enough questions and we're only through 3 of them. But let me switch to audience questions really quick. So Representative Foster from Illinois, great, 2 Chicago people here. It seems that most of the new initiatives we've heard about today use permission distributed ledgers. And Representative Foster is asking if that's a trend.
Yeah, so the Canton Ledger is, has, I guess, configurable permissioning, if you will. It has configurable privacy and also configurable permissioning. And so that's a nice hybrid environment that enables regulated entities to configure whatever levels of permissioning they need to operate in a regulatorily compliant manner. So we think that that's kind of the best of both worlds. Yeah.
I was just going to say, look, I had this debate with somebody who today in the room is doing something on the permissionless side. And I said, look, we're a regulated entity across the globe. Our tokenized money market funds better not end up in a wallet that isn't been approved on the whitelist and is AML KYC'd. We're going to be in trouble. So I don't know how you do that without, having a certain, whether it's programmed in the token to ensure that the wallet's clean. I just think that that's a reality.
Yeah, I mean, I was going to say the same thing. It's a reality of operating in the regulated space. It's something that there's different tools, obviously, for permissioning. I think there's been an evolution, perhaps, from private permission chains to looking at how you can enact permissioned environments within the public domain. But you know, the AML KYC requirements that we're rightly subject to, you know, that's a non-negotiable, particularly for institutional players. And so, having the ability to control that either through whitelists or hopefully in time through more, you know, perhaps more on-chain technology solutions enabling that, you know, I think that is going to be, you know, it's a critical part of how we operate our businesses today.
And not only, like, there's no disagreement, but I would almost take a step further. This is a luxurious point in time in that, going back to the initial point of this as a technology and this being nascent in the relative scheme of things, it's a unique time where you could build with no legacy in a way that should have a more rigorous AML KYC framework, because it's not about having people take a picture of their driver's license and fax it to you. So I think so much of the narrative is on what could go wrong, as opposed to the principles of how do you build something new that is actually both more efficient and more controlled for the most important elements relative to what we have today.
Did you say fax and crypto in the same conference? Wow.
Well, because we're running out of time, I do want to talk about what can go right. So I would love to hear where each of you think the tokenization space in particular will be over the next 5 years. Jenny?
You know, technology adoption is always slower. What was the saying? It's much slower. What is it? Yeah, but it's like, you know, the first 2 years, I can't really give a term, you know, it's much, much slower, and then it just takes off, and you can't imagine 10 years. That's what's going to happen here. Like, this is going to be one, first of all, going to these digital asset or crypto conference, I am stunned by the number of people who attend, the enthusiasm and the creativity that happens in these places. And I am also stunned to go in on the traditional side and how much they ignore it and say, another crypto winter, not gonna happen again, we don't need to pay attention to it. And at some point, you know, this, whether you call it a bridge or whatever, you have these pools of projects that are going on. You know, central banks have been working for a couple years in Asia and Europe on kind of being able to move their currencies on blockchain. And what's going to happen is these things are going to start to connect over time, and people are going to turn around and say, how did that happen so fast? And anybody who's been living in the ecosystem is going to say, are you kidding me? It's taken so much time. So, you know, is it 5 years that we see the hockey stick? I think so. I can tell you that I have more conversations about this where people are now inbound asking about it, as opposed to us saying, and by the way, I want to mention one other thing.
Yeah, so I have to preface this by saying that I'm usually wrong. You know, I lived in London in the mid-90s, and I watched the Bund futures pit completely disappear and be taken over by the DTB, which was, you know, now Deutsche Börse, the electronic platform. And then I moved back to Chicago in 96, and I was, you know, on the trading floor at the Merck, and I said, you know, if this place is not completely electronic by the year 2000, they're going to be out of business. And I was so wrong. Of course, eventually they became electronic. So I was right in the long term, just my timing was wrong. So with that preface, you know, my expectation is that in five years from now, that every instrument that is traded frequently will be traded on-chain. That is my prediction.
And I'll take it a step further. I think that a lot of this stuff is not an if, it's a when. It's hard to predict if it's 2030 or 2032 or 2027. But I think it's quite clear that if there are $4.5 trillion in digital wallets today, that number is going up, not down, and that wealth accumulation is going to have the ability to create the whole portfolio in that digital wallet. They'll have access to traditional capital markets instruments like stocks and bonds, and they'll have access to funds that companies like Franklin and BlackRock create. They'll have access to ETFs. They'll have access to model portfolios that will be on chain, hit a button, automatically happens and automatically rebalances. I believe these things are a question of when, not if. Someone had asked me the question, I wish I knew how to answer it. They said, with all of the wealth that's being created in AI, when you look, a lot of the fundraising that's been happening, a lot of it's been primary capital, but a lot of it's provided liquidity to employees. And they said, what % of that liquidity do you think is going into a Schwab account relative to going into a wallet? And I don't know what the answer is, but I think we all know some material component of that wealth creation is going into wallets. So it's just going to grow and grow and grow. And this will be another way for the capital markets to grow also.
Yeah, I think getting the timing estimates right here is always going to be very difficult. But I think, just look at how far we've come in a year. We're in a very different position now. And I think we'll continue to see that acceleration, particularly in the regulatory environment. To some extent, that was already advanced globally. And then, obviously, that has moved at pace in the US this year. I think next year we'll see significant advancement in terms of commercial bank money on chain. So, the cash side has really matured and will continue to do so, and see that as a significant area, in the shorter term. And then I think we will take the next step in that evolution towards some of the things we've talked about today in terms of structuring around more of the securities and assets side, which will build, so in 5 years, I think we'll have much clearer building blocks for sure that can then start to develop some of those, model portfolios and the kind of programmable investment vehicles, which is really where it starts to get very interesting.
Great. Ria, should we wrap up, or do we have 4 minutes? Okay, great. So final question, and we've touched on this a little bit, but given that we're here at the Federal Reserve, what do you think the Federal Reserve could be doing to help tokenization grow? I'll close with that.
Yeah, I mean, one thing I think the Federal Reserve could do is take the lead in putting together a cross-agency task force to help. I mean, because obviously this cuts across CFTC, SEC, OCC, to help think about tokenized collateral and best practices, et cetera. I think that would go a long way.
Transparency and clarity of regulatory environment is always what's so important for the market, right? People want to understand what the rules are of the road, and then they can build within that. And to the extent that and consistency across regulatory agencies, to the extent that there isn't clarity around that, that makes people fear innovation.
I think just to add to that, probably the kind of level playing field piece is important. So thinking about ensuring that we have the ability for regulated institutions and non-regulated institutions to participate on the same terms is critical.
And I would just echo that. I think that having more participation and more, I would say, embraced participation of highly regulated organizations, particularly banks, is going to be a dramatic catalyst towards unlocking innovation here. And I think the more that they're constrained or sort of on the sidelines, the harder it is for this to really get scale.
Yeah, I'll mention 2 more things. One is, thinking about, longer real-time gross settlement windows. And intraday liquidity for on-chain settlements, just kind of rules around that. And the other thing is, there are now rules that at some point in time in the future, repo is required to be cleared. And I think those rules were written in a time before on-chain activity was really taken seriously. And so I think it's important for the regulators to go back, take a look at those things, and make sure that they're not doing anything to actually hamper on-chain repo transactions.
Great. And with that, I'd like to thank Kara, Rob, Don, and Jenny. Really, really appreciate your time. Thank you.
Thank you. Well, we clearly have had a very engaging day on payments innovation. That's a big thanks to Rebecca, Kyle, Matt, and Colleen for leading our panels and for all of our panelists. I also want to say I have been super impressed by all of the energy in the room during our networking and the lunch. And that's a big thanks to everyone who came out to DC. So a big thanks to you for coming and being so actively engaged with us today. And I also hope everyone online enjoyed the event as well. And with that, I'm going to turn the floor over to Chris, who is going to take us to the final finish line.
All right, well, thank you, Susan. And let me begin to end things by thanking all the panelists and also those of you in the audience who engaged with some great discussion. I'm always struck by the fact, I've said this to a few people over the last day or so, every time I think I have an understanding of what's going on, I go to these things and I realize how little I know. So I have to keep going, so I keep learning and learning and learning. So sitting in the audience today reminds me of how important it is to listen and learn from innovators on the ground, both newer entrants and incumbents alike. Today allowed us not only to focus on what is happening in the payment system, but also to envision where it might go next, as we were talking a bit at the end. I jotted down some notes about what I've heard today, and I'll wrap things up by highlighting some of the really interesting points made and ask a few questions. It's clear from our discussions that innovation in payments is coming in many forms. What I heard from our panelists from discussions during the breaks is that the industry is moving as quickly as possible on a number of fronts, from finding ways to interoperate across and between traditional and new ecosystems, to reimagining the consumer purchase experience through the use of AI and AI agentic agents. All of this points to a future where payments move more rapidly, securely, and seamlessly across networks, both domestic and global. I also heard from many panelists about the growing importance of tokenized money in unlocking the next phase of payments innovation. We heard from a variety of panelists about evolving roles that could be played by stablecoins and commercial bank deposit tokens, and the potential efficiency and inclusivity gains these forms of tokenized dollars might deliver. And we ultimately heard a lot of discussion about very classic economics of payments issue. That's at the deep depth of my heart. Beyond technology, what stood out today was a spirit of collaboration across the ecosystem. I've noticed this over the last couple of years. Instead of, dude, we're going to take your job and drive you out of business, which was kind of the crypto world about 6, 7, 8 years ago, it's all like, how do we work together? I mean, this is a profound cultural change in the way people think about these things. We heard bankers and developers speaking the same language about openness, interoperability, and the need for shared standards. And we may have even coined a new term in scaled-fi. Things are changing fast in the world of payments, and it will be interesting to see a year from now how much has changed, or perhaps become more defined about the innovations we discussed today. It remains to be seen just how quickly some of the innovations being discussed now will be widely used or leveraged in the marketplace in the coming years. Now, how quickly might we reach that point, as discussed today, in which most consumers interact with tokenized money in their daily lives, unaware of the new technologies at play? I mean, that was kind of a theme. Consumers don't care about the technology underlying things. They just want to know, can I use my money to pay for something? Am I going to get money from somebody? They don't care how it gets done. We care about how it gets done, right? We do to make sure it's done efficiently, cheaply, and safely for those consumers. What will the blockchain infrastructure rails look like, and how many different stablecoins might circulate on these rails? I mean, I think this is a big question. There's a lot of talk about lots of stablecoins, but at the end of the day, consumers have to choose which of these things they want to use. It may be very widespread. There may be just a handful that actually are used, and the rest are just a tail. That's what we're going to find out by letting it loose and seeing what the consumers want to do. And which future innovations that are unforeseen today will challenge our assumptions on understanding what is possible in payments in the future. So thank you all for making this conference such an informative and enriching experience for me, and I believe all my colleagues here at the board. Thank you to those watching online, and a big thank you to the Fed staff who did such a spectacular job pulling this event together in a very short period of time. And with that, thank you and goodbye.